important thing. So what is it? So look at it this way, the market moves in phases. We're either impulse, correction. So we're either in an impulsive phase or a corrective phase. So really simple. Identifying these phases will be drilled into your subconscious. So with enough practice and eventually spotting these setups, it will all become second nature to you. You'll be surprised how quick you pick it up. Now let's take a look at an impulse. An impulse is the phase in which price moves in one direction with higher momentum than usual. So what you'll normally see within an impulse is big momentum either to the upside or to the downside. And you're going to identify these on multiple time frames. Now within the market, no market just consistently moves in impulses or in one direction. There is always corrections. We always have pullbacks. We always have within the market these cycles. So what they do, they signify opportunities for us to either enter at the market as an area of value. Now, as long as the rest of the strategy criteria is met in order to enter the trade, then it is good to go. But by understanding what phase we're in, understanding the true nature of the market, it really keeps you 10 steps ahead of the market. Now with corrections, what you'll see is that these are counter trend movements that normally they consolidate. So you'll see them moving sideways. And what they'll do is generally create a pattern in which that we're going to go in later on in this episode is how we identify patterns and what we use them for. Now the candlesticks within this correction, they're normally going to be noticeably smaller with no real progression in either direction and normally just moving sideways. So you're going to see just how easy they are to spot. The nature of the market is simply the characteristics of price action. So we have our phases, we have our impulse, we have our correction. So we have our impulsive phase and our corrective phase. The impulsive phase is normally that heavy momentum, those bigger moves either to the upside or to the downside. And then we have our corrective phases. These are normally either price moving sideways, and they normally take the shape of a pattern. Very low momentum, choppy price action sometimes can be the correction. So what we need to do as traders is that we need to identify what phase we're in. Once you know if you're in the impulsive phase or the corrective phase, you have a very, very good idea of what is going to happen next. So let's take a look at this. So let's look at this in a simple impulse correction. So we have our impulse, our correction, and then our impulse. So what we see is we have our heavy momentum with our impulse, which is with the trend, and then we have our correction, which is normally counter to the trend, followed by our impulse. So we have our heavy momentum, followed by our pattern, which is low momentum, this correction, and then we have our impulse. By doing that, we figure out what phase we're in. We know at this point, if we look at this at the corrective phase, we have a very good idea of what is to come next. So it really gives us a true edge. I often feel that the nature of the market is overlooked, but at the same time, single-handedly, the most important thing. Remember, trend lines, all these kind of things, that is just framework and guidelines from the nature. First, we understand the true nature of the market, then everything else will make much more sense and give us way more clarity within the market. Now, with the nature of the market, you understand the simplistic basics now, but what I want to do is I want to take you through this on the charts so you can see exactly what we're looking at. So let's get into the charts now. Now on the Euro Japanese yen, let's take a look at this price action that we have in here when I zoom in. So as you can see, something similar to what I previously just drew. We have our impulse, correction, and then our impulse. Notice how we have that heavy momentum followed by our correction, which is counter to the trend, and then we have our impulse, which is with the trend. You see how key, by understanding what phase we're in, it gives us a very, very good indication of what is to come next. By looking at this right now, understanding that this is the corrective part, see how this is a major key. It gives us a good indication of what possible opportunities do I want to look at next. Now, if we just look at this in the most simple format, let's zoom in a little bit more, because look, guys and girls, the nature of how this is moving is the most important thing. And this is the part that I feel that is overlooked. Look at the impulsive phase, something that's very clear. We can clearly identify that this is an impulse and we move into the correction. So what I would like you guys and girls to do is zoom in as much as possible to see, because sometimes what appears to be an impulse can sometimes be a correction, and it can get a little bit choppy, a little bit more in depth. But for now, just to keep that very, very simple, look at the impulsive nature and the corrective nature, and really look on that as many currency pairs as possible for you to really identify, right, what phase am I in? Am I in the impulsive phase or am I in the corrective phase? So now you've got a good idea of the nature of the market. Now let's take a look at structure. So why do we believe in nature and structure over, let's say, indicators and support and resistance, these things you may have heard of before? So the basics of nature theory is understanding that no matter what price is doing at any given moment, what is forming, where it is, we can outline what phase a chart or the currency is actually in, rather than relying on indicators that are lagging or putting any heavy significance into levels that can easily be broken at any point. We put extra effort into understanding the entire chart. We put extra effort into understanding what is possible within the market by keeping it as simple as possible. Now, as a beginner, you're going to see just how simple we keep our charts and only really using the tools to analyze the price action as a whole. Now, as a trader with experience, if you're reading this course, you might find it a little bit different to what you're used to, what you've learned in the past, but very quickly you'll realize how much more efficient this way of trading is. And the market has moved this way from day one. But what people have developed over time is they've exploited these areas and created a lot of mess just to confuse more people, when in reality, keeping things simple and going back to raw price action is the most reliable form. And what you're going to learn is how to capitalize fully on these positions and build on them. So now let's take a look at structure on the charts, and let's take a look at how we actually build that structure, keeping it as simple as possible. So now you understand the nature of the market, it's very important to move on to the next stage, which is the structure. Now, previously in lesson 2, I covered trend lines and ray lines. Now with structure, all we need is trend lines, and what you're going to learn later on in this episode, how we use ray lines as well. Now remember that this episode and this overall particular section is the real meat and potatoes of the overall style and strategy. So make sure that when it comes to this section that you watch it as many times as possible. Take your time with it because you're going to learn an awful lot. So what we're going to do now is identify what structure is and how we actually use it. We're going to start off with the monthly chart, and the reason why we start off with the monthly chart is because it gives us a very reliable form of looking at the outer structure, and we're going to work our way down using the multi-time frame analysis in this whole episode and showing you how we use it along the way to identify each particular structure. So let's firstly start off with the monthly. What we really want to do at this stage is we want to identify what parameters we are within. So let's look at that in this section. So we have on this pair euro yen. Now, when we look at this section, we want to take our trend line that you configured in your trading view, and we want to use it to outline our parameters. So we take our trend lines and start to draw our structure. Now you can do this along the way, or you can pause it or do it with another screen that you may have. So by doing this on the monthly chart, what we're figuring out is what is our outer structure. By understanding our outer structure, it really gives us these parameters. So we can see the price, we can see what we have within, you can see just how clean the charts are and how simple we really need to keep it. So what I like to do at this stage with the structure is keep it as simple as possible. So let's make the chart as big as possible. So when we look at it here, we can see our outer structure, and we want to firstly focus on, with structure, you're going to have trend, you're going to have patterns, and within the overall particular price, what you're going to find with the patterns is that we have smaller structures. So structures can come in the form of patterns, they can come in the form of trends. And what we're doing is we're breaking down the time frames and utilizing what is the most reliable form. Now, although within Falcon, what we found to be most reliable is focusing on the most recent bit of price action, that's going to give you the most reliable form of current behavior. But it's important to look left and notice how this actually behaves. We cover a lot more of this in backtesting in later sections, and you're going to see how you can utilize all of the data. But for now, we want to focus on what is the most recent price action and how can we benefit from that, understanding really, are we looking for buying opportunities or selling opportunities? So firstly, let's do a little bit of looking left and looking at previous trend. So if we look at the most relevant bit of the price, just to understand on a very basic level, how is the market moving? We can see that we've been moving in this uptrend for a while, since 2000 all the way to 2008. And then we started to get those bigger moves down. And what we're going to find within here is we start to develop these patterns, in which we outline in the later episodes all of the different patterns that we use. But to keep it on a simple level, even from this perspective, you can see we're moving in an upward trend, and then we move down impulsively and then start to create this downward trend. What starts to happen with these structures is they give us forms of patterns, and you can see that this descending falling wedge type pattern, which you're going to learn how they behave on all time frames, is giving us this structure. And you can see how it played out perfectly is how these patterns are meant to play out as we get the bigger impulses to the upside. Now, what you're going to find when you're identifying structure is certain types of situations, you're going to be drawing your trend line, drawing your patterns, and you're going to see sections like this in which it kind of doesn't make too much sense and it seems a bit messy. When that happens, you have to understand that the market has cycles and sometimes price is messy. And it's important to note is that you don't need to overthink it. And sometimes we have those cycles and that we look at different currency pairs if it's not giving us clean structure. But the majority of the time, we do get clean structure. So let's take a look at what we have next. So we want to go to the most reliable form of price, still being on the monthly at this stage, and just outline what we have. So we can see here that we have our outer structure here. And it's important to notice that make sure when you're drawing your trend, as I mentioned in lessons before, make sure you're drawing it right to the wick, as it gives us the most reliable form of price structure. And how we do that is by understanding as a whole. We can see this overall bigger structure. Look how simple we've kept it. We can see the outer structure. Now what we want to do is see what is going on within this section, and we work our way down. So let's go to the weekly. All we're doing here by utilizing these time frames is we're working our way down and really just zooming in to see what is actually happening. And then we can adjust along the way right to the wick to see what is happening. Now, as you can see here, we've just got a typical bounce, 1, 2 touches. And now we have an area in which that we can look at to see, is price going to move all the way to the downside? And how we do that is by understanding the current price structure. As I mentioned, the most important bit of information is what is currently going on, not what happened 4 or 5 years ago. What is important is what is going on here. So now we've identified the trend using our inner structures. We have 1, 2. Let's see if there are any potentials for us to look to sell this, as we have an outer structure here. But what I want to do also is add in these parameters. So we can see as we adjust our trend line, the most reliable form is this structure. As we move it to the wick, and you can see how simple we keep it. As we move it to the wick, we can then outline that. If we look left and we look at price previously, you can see how price really wasn't giving us the cleanest of structure. It was just kind of trickling its way down. And as I draw it on roughly, as you see, this was price just trickling its way down. And as soon as we get to this area, you can see we start to form structure. We start to form this piece of its own. And then what we do in Falcon a lot is that we focus on sections as pieces of their own, as we found that to be more reliable. And it's very unique to Falcon to understand that each particular section is just a piece of its own, rather than trying to complicate trend lines from 1984. It's just not necessary. So what we always focus on is, when we're looking at the strategy, it's always based on a form of reliability. So when we're looking at this current price structure, let's take a look at what we previously touched on in nature. If we go down to the daily chart, we're zooming in again and looking at what current price is telling us. So again, as we adjust and make sure that we get that right to the wick, and you can see the structure matches up very nicely. What we really like about Euro Yen is its behavior. And you're going to learn how to really understand different behavior on charts, on different pairs, when you learn how to backtest. But for now, let's bring it back to the nature. So as previously touched on nature, you understand that we have our impulse, we have our correction, and we have our impulse. So at this stage, we want to look at what structures do we have within this particular piece and what can be of benefit to us. So as we can see the market moving up as an impulse, we can see the correction, we can see the impulse move up, and then we can see the correction here, and then we start to form a whole new correction. So at this stage, the most relevant bit of information is understanding the nature of what previously happened, and then taking it one step further and seeing what is going to benefit us the most. So we can look at previous price and see, well, this is where we had our particular trend line, and all we've done here is we impulsed up, we corrected, we impulsed up, we corrected, and then formed a correction. So as you can see, this doesn't really benefit us right now, but understanding the nature does. What we can do is take that one step further and look at this. So we can look at current price and see exactly how we responded. Now this is another reversal ascending channel, which you're going to learn in the pattern section, and as it played out very nicely, that we've been looking at this for a while. Now when we look at this ascending structure, you can see we've moved to the downside and we're starting to form clearer structure. And then what we do is we build on that case. We're always building a case of evidence for each particular trade by utilizing the higher time frames, working our way down and actually looking at the lower time frames. With euro yen and any currency pair, what we normally do is we break all the way down to the 4 hour and the 1 hour. At this stage, it's not necessary because what you're literally understanding now is just what is the overall outer structure. And when we're looking at it now, we can start to form a particular trend. We can see that we've gone from an ascending structure and we've started to move in a downtrend. Let's take that one step further and draw some parallel lines to see exactly what is going on within the market. So this is the most relevant form, and what we like to look at is the most recent 2 touches. And as we look at this section, what would be actually really good to show you guys and girls, let's actually break it down to the 4 hour just so you can see what would be the most reliable form. So as you can see, these are our outer structures, but what we have within the structures is current price. And when we look at that, let's zoom in so you can see that we're starting to form a new structure. And the reason we know that is that we've actually bounced off of this area, so we know that is a relevant point to put in. And if I move this out the way for a second, so you can see the most reliable form, this structure here is starting to form a particular pattern that we focus on in Falcon a lot. And what we do is we're always anticipating these structures and these moves to learn to capitalize. And by doing that, it keeps us 10 steps ahead of the market and moving you closer towards achieving your goals. And it's the most important thing as a trader, that you have goals, but then you focus on building each piece together. So take your time with this section and make sure that you understand all the principles. But now let's take a look at a particular section after the structure. Now we've had these 2 touches, we can see that this is the most reliable form, and let's add in anything that we need. We can always look left within the current most recent price action, see if there's any trends, see if there's anything that can make it clearer for us. So we can see at that stage that we've just given us a move up. So we've had this correction here and we've moved down and we're just starting to form a newer correction. So what we can do is to outline the parameters we're in. You can see that this is the most relevant form, these last 2 touches. So we have 1, 2. What you're going to find is that when you're drawing your trend lines, it's okay to dig into the time frames and draw a trend line and realize, right, we need to change that because you're going to see more and more information. That is what it's about. It's adjusting along the way and understanding what is happening. So when we can see here, now we have our most reliable form of touches. We have our structure. We can see that this new structure is forming. This now gives us a competitive advantage in the market by understanding what is the structure we're within. We've outlined our parameters here, so we can see this is the outer trend line. Can we look for any opportunities, as you can see the market moving to the downside, that would give us an indication to look for selling opportunities? So this is how simple we keep structure and how we build it. So now you've understood the nature, you've understood how the structure is and how simple you can do that. Make sure that you exercise this and use it on a lot of charts. Just get any blank chart on any currency pair and start building the structure. Don't worry if you don't get it straight away or you find any information overwhelming. I promise you, before you know it, it's going to become second nature. So now we understand nature and structure. Let's move into impulse and corrections and how we can utilize the current structures that we have to really understand what phase we're in. So let's look at that now. So now we understand the nature of the market and the structure. Let's build on the next stage. So impulse and corrections. So within the market, we've identified the nature of the market. We understand that we have corrective phases and impulsive phases, but what is impulse and correction and 1, 2, 3 wave structures? So 1, 2, 3 wave structures are essentially a series of impulses and corrections. So after a reversal pattern, a change in trend is confirmed, the first impulse slash wave in the other direction would be considered one. The corrective phase, the consolidation part, after this would be considered two. And then the next phase, which would be the impulse phase, would be considered three. So really, really simple. Once you learn how to actually identify this on the chart, you'll see how easy it is and how you'll consistently see 1, 2, 3 here, 1, 2, 3 there, and you'll be able to spot them. Now, the amount of impulses and corrections that can occur, it doesn't actually have to be three, for example. This is just an outline of what we look for and to further cement the fact that the price moves in phases called impulse and corrections. Sometimes we'll have things that move in a little bit more differently, but we always want to assume the clean setup. We always want to assume that we're looking for 1, 2, 3. Sometimes these structures evolved, and of course we have variations within the strategy to be prepared for that. We have variations to be able to understand when something is changing the structure and evolve, which is exactly what you're going to learn later on in this episode. Now, I understand some of this might seem a little bit confusing, so let's just take a quick look at an example of what this looks like visually on the charts. It's honestly really simple, guys and girls, so let's take a look at that now. So now that you understand the nature, you understand the structure, it's very important to understand now impulse and correction. Now we've touched on it ever so slightly, but now I want to get into the next stage of impulse and corrections. As we know that the market moves impulsively and correctively, but we also have impulsive and corrective phases. Knowing what phase you're in is one of the most important things within the market. So firstly, think of your structure as your foundation, your building blocks. And then when we look at impulse and corrections, we're just building a layer. So by understanding what phase you're in, you're building a layer of evidence to take a trade and building that pathway to all of the reasons of why you should take these positions. And if we look at the current structure, let's take a look at what phases we're in. Now, it's important to note before we begin that in a lot of strategies, candlesticks are used heavily. Now, in Falcon, candlesticks, they are important, but they're used secondary. Nature and structure is always primary, as we found that to be the most reliable form. What we use is candlesticks to identify what phase we're in, and we use them as an extra layer of confluence to be able to build on our trades. So now let's take a look at the phases. So firstly, let's start off with the impulsive phase, and I want to start off with the daily chart, as we found that on the daily chart it really gives us the clearest form of what phase we're in. Now, if we look at the current price action within this area here, how we identify it is very obvious. And if you're trying to look too hard, you're probably overcomplicating it. So let's look at how simple it is. The impulsive phase, you're going to see very much bullish engulfing candles and see a lot of momentum in the dominant direction. So if you can see this in the section, we have it's very clear to identify that's an impulse. So when we see that section there, the majority of the move is very, very impulsive. Now, what we have next with natural progression is a correction. So we know the market is moving impulsive and moving corrective. So normally after the impulsive phase, we have a corrective phase. So as you can see, this correction here. The reason why this is super important to understand what phase we're in is because now we know we've had an impulse, then we've had a correction. If we're in the corrective phase, what is next? What would be natural progression within the market is to have another impulse. So what have we had here? We've had an impulse out. The reason why this is super important is because by knowing that we're in this corrective phase, it gets our mind geared. It gets us forecasting and focusing on the fact that there are bigger moves to the upside. So we anticipate these bigger moves, which is exactly why we have an edge by understanding what phase we're in the market. So let's look at this piece here. So we've had our impulse, we've had our correction, we've had our impulse. Notice this section here, it looks very similar to this correction. So let's clean this up a little bit so you can see. Notice this section, this correction, looks very similar to this correction here. So as you see that correction, what would be expecting next? An impulse. But what did we get? We just moved out very slowly. So what it does for us is we can start to anticipate when the phase is changing. So normally if this was going to be continue as an impulse, we would have had an impulse above the high. We would have broken that very impulsively, and you would see something like this. You would see something like this. But what did we get? We just trickled our way sideways. So what it does for us is understanding that within the corrective phase, we may get smaller momentum. We may just trickle our way to the upside or to the downside. In this case, we've just created an ascending reversal channel. The reason why this is very important to understand these patterns and the structure is it really just paves the way for the bigger direction. As we know that if this is an ascending reversal and we know what phase we're in, we know what is likely to come next is selling opportunities. And within the phase, can we take advantage of that? So now let's take a look at the matrix of impulsive and corrections. So with an impulse and a correction, although we have our higher time frames, our bigger structures, within a correction, so something like this, we can identify this as one piece of its own. Within a correction, we know there's going to be impulses as well. So the reason why that's important is it enables us to take advantage of the market even when the market is forming a bigger correction. But by knowing that this is just one big ascending correction, at least we know the dominant move to come is a selling opportunity. So we know that by understanding this structure. But in the medium term, can we take advantage of making percentage, making money in the markets? Yes, we can. So let's look at it in this light. If we have, let's say, an impulse, a correction, an impulse, a correction, an impulse, a correction, if we just draw on there, what are we actually forming? What we're actually forming here is a correction. So by understanding this, it's very, very important. By understanding that phase there, just because this is a correction, it doesn't mean we can't buy within it and take advantage of it, because what we're getting here is continuation. What we're getting here is an impulse, a correction, an impulse, a correction, an impulse, a correction. But based on this pattern, that you're going to learn a lot about patterns in this episode, is that this is actually a selling opportunity. But it means in the short term, we can identify and say, although there's impulses and corrections, this whole move is actually a correction. It's just within the matrix of it, there are still impulses. Now, don't worry if you don't get this straight away, but you're going to really have those breakthrough moments. Whether you're a new trader or an experienced trader, you're going to find that this is what really sets us apart by understanding what phase we're in. So now we know that we could take advantage of the market. Let's actually take a look at some lower time frames to see if anything applies. If we go to the 4 hour and we work our way down, you're going to see particular phases. So let's take a look at this current phase here. So after previously understanding the fact that we had the impulse, we had the correction, we had the impulse, we had the correction, and then we didn't get the impulse, and this started to form a corrective phase, we can only assume within there are short-term buying opportunities. So let's take a look at that. If we zoom in and we look at the phase, we can start to draw trend as we have our touches 1, 2, and we're forming our trend lines and our structures. So very similar to the structure that we just drew. And let's take a look at that. So if we just hide the price so you can see what this structure is showing us, within that, it's the same exact thing. So we understand what phase we're in, so we're able to anticipate that we have an impulse, we had the correction, we had an impulse, we had the correction, and we have an impulse, and we had the correction. So by understanding what phase we're in, it gives us a competitive advantage that when we're taking these trades, there may only be short term, because we understand the corrective phase is likely to impulse correct, and pull back. And by doing that, we know that we're going to be setting profit targets. Understanding the structure really is your true edge, because it enables you to lock in as much profit as possible by understanding the phase. And that is literally how simple we keep it with impulsive phases and corrective phases. And with the corrective phases, it's very, very important we understand how to differentiate whether something is an impulse or a correction. So understanding the fact that yes, we will have impulses within corrections, what really defines it and makes it up as a correction? So we have something within Falcon called the 80-20 rule. Now, all that means, quite simply, that if we're looking at an overall structure, let's say this one, for example, so we're looking at the Great British Pound over the Canadian dollar. Now, when we're looking at this structure, we can, yes, see that we have this overall ascending channel, but what is very important here is the fact that we have an impulse here, we have an impulse here, an impulse down, an impulse up, and then an impulse down, an impulsive candle here. So we do have a few impulses, but nevertheless, we can see that 80-20, so 80% of this move is very corrective. So then we can identify it as a correction. What you're going to have sometimes is things like a move up, a correction, an impulse, a correction, an impulse, a correction. And what you're going to figure out is that you're going to ask yourself questions such as, am I in the impulsive phase or corrective phase? Because I have an impulse there, I have an impulse there, and I have an impulse there. But you can see the majority of the move will always be a correction, correction, correction. There's actually only 3 impulses within them. So we use that 80-20 principle to really differentiate and understand what is a correction and what is an impulse. The majority of the time, you're going to find them very simple and they're very easy to see. But in certain types of situations where you have a few impulses within them, the easiest way to differentiate that is to understand the 80-20 rule. So a very, very simple process, and you can apply that to all these corrections. So make sure that you look at that for yourself, so then you've got something mathematically to understand what phase you're in. So as a great exercise, what you can now do, guys and girls, is you can find your phases, figure out, are you in the corrective phase or are you in the impulsive phase? Now, sometimes it may take you a little bit of time at the beginning, but overall, you're going to see by understanding that how these structures play out. And as you can tell, played out perfectly as we anticipated this ascending structure, the corrective phase. It's only a matter of time until this moves to the downside, which we can see. And the same way that we have the most recent price structure, as I go back to this area, what do you guys and girls, from knowing what you know now, what you think will happen within the future? When we look at this, it's exactly the same thing. The same way that we have a bigger structure here, this section is just a smaller version of this bigger structure. So by understanding what phase you're in, it gives us an anticipation that if this is the corrective phase, what is likely to happen next? Well, we're likely to get some selling opportunities. So you can already start to see what potential we may get next. So by understanding the phases, it really does give us our edge. So pick as many currency pairs as possible, go through the charts, and as an exercise, write down what you believe is the impulsive phase and the corrective phase, and you're going to see the market in a whole new light. So now you understand that we have the nature of the market, the structure, the impulsive and corrective phases. Now let's move into multi-time frame analysis, in which we really break it down from the monthly, weekly, daily, 4-hour and 1 hour. These are our most common time frames that we use, and we're going to show you how we utilize them to build that extra layer and cases of evidence to build those trades. So let's look into that now. So now let's take a look at multi-time frame analysis. So I'm sure you've seen how simple we keep it on the charts with our impulses and our corrections, understanding the market structure and the nature of the market. So what do we do next? How do we really build on those positions? Now, what we look for within multi-time frame analysis is we look for the higher time frames all the way to the lower time frames to really build a case of evidence and reasons for taking a particular position. So having that top-down analysis is the procedure of first analyzing price on the weekly and working your way down through the time frames to figure out what kind of entries are going to suit the criteria. By doing this every time on the charts, we can ensure that we're not forgetting the bigger picture. We're not getting caught up into the intraday smaller time frames or the price action. That's where you see a lot of noise. So we're looking for the higher time frames to understand that this is the true structure. This is the bigger picture showing us the direction. And within those lower time frames is where we can take advantage of particular trades on maybe a short-term basis. Now, this can sometimes be a little bit of a bad habit when you're going into too much of the lower time frames, because what you're going to do is you're going to see that if you don't understand what you're doing within the market, You can drill down to really, really lower time frames that we don't use, and then you start to lose positions repeatedly. You start to overtrade. You're not taking into consideration what is actually happening on the larger scale. So what we do is that we align all those together, and then we understand when we can take, let's say, a counter trend trade against the bigger picture for maybe a short term trade. And then we understand that by trading with the trend, trading with the overall high time frame analysis, we can align those as well for the bigger trades. So by understanding that, you're going to always have clarity on why you're actually taking a position rather than just, putting trades on for the sake of it. So as I mentioned previously about the reversals and the continuations, the top-down analysis is absolutely essential, important factor when analyzing these patterns. For example, an impulse movement on the weekly will be zoomed in, so to speak. On the daily chart, this is going to appear as an impulse correction on the daily. So sometimes when you're looking on a higher time frame on the weekly chart, there may not be too much direction that you see. So by us moving down to the lower time frames from the daily, the 4-hour chart, and then the 1-hour chart, we're able to see what is not visible on the higher time frames. So sometimes you can look on the weekly and say, it doesn't really make that much sense. I need a clearer picture. So when we drill down to the daily chart, we're then able to see more of is there any impulses or corrections, or is there any clearer patterns for us to identify what is actually happening within the market? But the best way to do that is to look at that on the chart. So let's take a look at that. So now let's take a look at multi-time frame analysis. And this is one of my favorite sections, as this is where you really start to learn to build a case of evidence, utilizing all of the time frames from the higher time frames to the lower time frames, so you understand exactly what is going on. A lot of traders, they really don't look at the bigger picture, and they're far too zoomed in on the lower time frames as a whole. Although that we do use the lower time frames for entries, we're always looking at the bigger picture. So previously we touched on nature, we touched on structure, understanding our impulses and corrections. And now as we move into multi-time frame analysis, you're going to learn what are the time frames that we utilize the most, what are our favorite ones, and what do we focus on the most that really helps and aids us into being able to profit in the most effective and efficient way. What you're going to do is implement this as a routine. So you have a habit of working your way down in a top-down analysis, and you're utilizing all of the time frames so they align. So firstly, let's start off with the monthly. So with the monthly chart, you're literally going to use this as your outer structure. The monthly chart often is going to remain there for a long period of time, as it will hold a lot of relevance. As you can see with all the previous price, that when we had this particular area here, this is our outer structure, and this will hold relevance for a long period of time. As you can see, prices moves all the way from here, and potentially in the future we may see price within this area. So as you can see, the monthly really is for the overall bigger structure and will hold a lot of relevance for a long period of time. Where we really utilize the time frames and the ones that we focus on the most is the weekly, the daily, the 4-hour and the 1-hour. That is where we really capitalize on the market. As often traders, they get too caught up onto the higher time frames, they disregard what is really going on, and sometimes the monthly chart, the quarterly charts, the yearly charts, they can take a long time to play out. And remember the game, we're in this to make money and make percentage, so let's focus on what's most reliable and going to move us closer towards our trading goals. So let's take a look at that. So what I want to do is highlight a particular section and break down from a multi-time frame analysis what we're focusing on. Now, as you can see within this section here, we have this, and you can say that it's a monthly trend line, but overall it just looks clearer and clearer as the lower time frames. But let's take a look at this structure. What you may see on a high time frame is not visible on the lower time frame. So let's actually drop to the weekly, where we utilize this time frame the most. So when we go to the weekly chart, the area that I want to circle the most is this area here. So if we just take a look at this overall section, we're going to be focusing on price and what behavior we see within here and how we can utilize it as a trader. So if we just look at the structure and we have our outer perimeters here, we can see that we have one touch here and we have our second touch. After we've had our second touch within the market, we can see we're trending in an upwards direction. So now what we need to understand is there anything here that would give us an indication to look for opportunities to make percentage to the upside? Well, what we see on the weekly may not be visible. So what we really need to do is dig down and zoom in. So let's go to the daily chart. So when we go to the daily chart, you can see the area that I've circled. All it's done is given us a clearer picture of exactly what we've seen. So within this same area, this bounce off of the trend line, we're looking to see what is possible. Now, we know we're in the impulsive phase, especially after this big impulse here. But with that impulse, when we're looking for entries, we're digging our way down to see what is happening. So let's now go to the 4-hour chart to see what we can see. So as we zoom into the 4-hour chart, notice how you can now see these corrections. Notice how you can see the impulse, correction, impulse, correction, impulse, correction. So we couldn't see that on the weekly or the daily, but as soon as we went to the 4-hour chart, we can start to utilize that and see that along the way. Now when we go to the 1 hour, it gets even clearer. So let's go to the 1-hour chart in the same section. So when we go to the 1-hour chart, you'll be able to see how clear these corrections really are. And this is where we utilize our entries. Now you're going to learn later on in this episode exactly how we enter the market and what patterns we're focusing on. But we're going to look at this as just impulse and correction in its simplest form. So now we can mark those on and see exactly what's going on there and mark them on neater. So you can see the impulse and the correction. We have another impulse and a correction. And we have another impulse and correction. So as you can see, getting too caught up on the higher time frames can sometimes leave you missing out on positions. So by understanding the structure and then seeing what's going on here, you can see that we have impulse correction, impulse correction, impulse and correction. We know that's how the market moves. So all we've really done is we've gone from the higher time frames to the lower time frames to build a case of evidence, because we can see on the higher time frame what direction we expect the market to go, and then we work our way down to the lower time frames to see, can we utilize and what patterns do we need to see, what criteria needs to be met before we take those trades. And the irony is, if we zoom back out to the daily chart, as you're going to utilize this as a habit, what you'll find the most as a trader, you'll be on the daily chart a lot. Every single day, of course, you check that as the daily closes and you can see what is happening with the price. What you're going to see is that we know the matrix of the market, that you've learned that the market just moves in impulsive phases and corrective phases, and we're always moving impulsively or correctively. This same section, as you can see, is overall just one big correction. So this is the impulse and this is the correction, and then there's the impulse, and then there's the correction, there's the impulse. So you can see the market is always moving in the state of impulse and corrective. So all we need to do with these higher time frames, working our way down, we're just zooming into those same areas to then see how can we utilize that, because we can already see the higher time frame structure is paving the way, is giving us the direction. And what we actually have here is a pattern. What we have here, I'm going to draw on for you guys and girls, and you're going to learn a lot about the patterns in the next lesson, how they behave, what they mean, and how we utilize them. But what we actually do have here is a particular pattern. And then what we do have here as well is another pattern that we utilize. And we also have another pattern. And we have another pattern here. So we're either moving in a state of continuation or reversal. And within patterns, you're going to learn exactly what the main continuations we focus on and the main reversal patterns that we focus on. So as you can see, when you zoom out, the market is very simple. It moves impulsively or correctively. Impulse correction, impulse correction, impulse correction, and then this is a correction. So now what you can do, you can go on any currency pair and then identify the market nature, the structure, identify the corrective or impulsive phases, and then what you're going to do is utilize the multi-time frame analysis. So as a great exercise, start off with the monthly, work your way down to the weekly, the daily, the 4-hour and the 1 hour, and see if you can predict the overall direction of what you believe the structure is telling you, and then work your way down to then see on the lower time frame what may have not been visible on the higher time frame. So that is exactly how simple we keep it. And by adding all the components that you've learned so far, and now understanding multi-time frame analysis and how simple and what it really means, we now then move on to these patterns that I've outlined, and you're going to learn exactly how they behave and how we utilize them. And then after that, we're going to learn about entry types and then how to really utilize and be as precise as possible. So understand that when you're learning this way, you're not going to know everything at this stage, but we're starting to build the pieces to the puzzle. And eventually, at the end of the lesson and this whole series, you're going to learn exactly how to execute in the most efficient and effective manner, and it's keeping it as simple as possible. So let's move into actually understanding what patterns we focus on and how they behave. So now let's take a look at patterns. So slowly, you can see how we're building all of these key components, but we're keeping it as simple as possible. And that's the most important, crucial thing. But understanding the identification of patterns has been a true game changer for the community, but more so for myself over my 9 years experience of trading the markets. So let's look at that in a little bit more detail. So patterns are really the lifeblood of the Falcon strategy. Nature theory, of course, plays into those patterns, as understanding the behavior of what price is doing leads into what these patterns are forming and why they're actually behaving that way. It gives us a really good indication of what's going to happen next by the nature of the market combined with the patterns. So there is a list of patterns that you're going to learn. Our mission, of course, is to make sure that you can identify the phase that the price is in every type of market situation, so you can build that confidence when you're executing positions. By doing that, you're going to have clarity. Once you know what the nature of the market is doing, what the structure is telling you, are we in an impulsive phase or a corrective phase? And now you add pattern identification, which is the most reliable form of proven trading since day one of the market, you're going to have absolute clarity in the direction that the market is moving. So when patterns fall into one or two categories, what we look at is we either look at the patterns in a continuation state or reversal. So we have the continuations and the reversals. Continuations are a continuation of an existing trend. So it goes back to the 1, 2, 3. So for example, if we have an impulse and then a correction, and then we have the next impulse. So the next impulse is the continuation of the trend. So what you'll see is the market, let's say, for example, we have a move up, a heavy momentum to the upside, and then we have a sideways correction, and then we have an impulse up again. That will be the continuation of the trend. By understanding the pattern in between, we're able to understand that, well, if this is the continuation of the trend, then we know that we're only looking for possibilities to buy that trade. So you see how the pattern really fits together with that. Now, if we take a look at reversals, reversals are normally at the end of a trend and the start of a potential another trend. And what we see with those is normally very, very particular price patterns that we're going to show you that gives us a good indication that the market is either running out of steam and it wants to reverse. So what we may have is continuation patterns leading up to the reversal. And then what the reversal does is it gives us a good indication to manage our previous trades. So let's say, for example, we may be buying something and then at the top of a particular structure, it gives us a reversal. That gives us a good indication. Let's lock in profit of what we're already bought previously and now potentially be neutral and look for selling opportunities the next way. So by building that, it really gives us a good indication of where the market's going next. So let's take a look at that on some charts and look into some patterns. Bull flag. Now, within these patterns, you can apply the same methods to all time frames. So if you see a bull flag on the daily, it's exactly the same thing as seeing it on the 4 hour or the 1 hour. So let's firstly start off with the bull flag. And I'm going to go to the 1 hour for this. So when we go to the 1 hour, let's take a look at the bull flag. Now, this is going to be something commonly seen within Falcon. It's a very, very reliable flag that we like to look at, and it's often seen within the 1 hour chart. So this bull flag continuation, the great thing that separates it really is where it comes from. So what you'll notice is it comes from an impulse. Now, not all the time you're going to see this impulse in just one 1 hour candle. Sometimes you'll see it in 2 or 3, but overall you're going to see the momentum is greatly to the upside, and then we get a correction which is counter trend, resembling a flag. Now, flags, they can all come in different variations and sizes. Sometimes they're like this. What we look for within the flag is at least 2 touches like this to define the bottom of the flag. once we've got the bottom of the flag and we have 2 touches at the top, we can then start to identify the correction and what it looks like. Our aim is with this type of continuation is to be buying on the breakout. We're buying in the anticipation that this is impulse, correction, and the names within the pattern, the continuation of the trend. So by doing this and identifying these patterns, it's very reliable to get involved in these type of setups. And we found these to be absolutely fantastic. Now we're going to get into the entry types of where to put our entries and our stop loss in entry types later on in this episode. But firstly, I want to go through the patterns so you can understand how they behave and what we're really looking at for them and keeping it as simple as possible. So that is the bull flag. Now let's look at the reverse and look at the bear flag. So if we look at the bear flag, notice how this bear flag gives us the same type of correction, but look at the difference in the angle. This has more of a triangular feel to it. So exactly like I said previously, not every type of continuation has all these different names for it. What we focus on is the structure. So we have a slight variation, but what we're looking at is what happened previously, which is the pole of the flag. So we have the impulse to the upside, the correction, and then the impulse. Now we have the impulse to the downside, the correction, and then the impulse. So we're looking at it in the same way. Now with flags, bull flags and bear flags, you're going to have different types of them. Some of them are slightly larger. They have a defined, second touch. Sometimes they have 3 or 4 touches, but you want a couple of touches as a minimum. The only other flag that we look at that is normally quite tighter is ones like this. So as you can see with this bear flag here, notice how it's very, very tight. They're very congested all together, a very, very tight correction. This is what we call tight flags. And generally, what we have after we get a move down, we get a 6 to 8 hour correction. So mathematically, what we've seen from historical data is that after 6 to 8 hours, that is good for us to put an entry on. So you can start to count the candles and realize if we've got a minimum of 6 hours and we're taking, let's say, a trade for a selling opportunity, and we've built the multi-time frame analysis, the structure, the nature, and we have a good setup, what we'll be looking for is that 6 to 8 hour correction before selling. So very simple. Some of them are going to be very tight like this, and some of them are going to be slightly larger. But can you see the structure is exactly the same? And that's giving us the sense of the direction. So those are the main things that we really look at with continuation, bull flag and bear flag. And the interesting thing to note is if I just go to the 4 hours so you can see the overall pattern, the overall patterns that we were looking at within here, if you look at this overall move, yes, there's impulse and corrections, but this whole move is an impulse, and then that is a correction, and then followed by an impulse. So as you can see, there are impulses and corrections within impulses and corrections. It's just understanding the higher time frame is going to showcase for the bigger dominant trend. And even in this piece here, this corrective phase, we can still buy and sell within there and capitalize on the market. And that really is the great thing about trading this way, how much opportunity we're able to capitalize within the market. So now we've done those continuations, let's take a look at some reversal patterns. So firstly, I want to start off with the ascending channel. And there's a few different variations that I want to focus on here that's going to help out a lot. So firstly, let's take a look at this ascending channel that we have here. One thing that I want to bring in is the use of ray lines. So we mentioned it in lesson 2 about ray lines and showcase that we use trend lines and ray lines to identify the structure. Often what you'll see on people's charts is something called support and resistance. Now, although that we have an element of that, we don't use it the same way. So what a support line would be, it would go through all of price. So when you draw it, it would literally go through every single part of price. But what we use is ray lines here to identify certain points and certain targets. Now with the ascending channel, you're going to see how we utilize that. Let's take this channel, for example. We understand that the nature of this is ascending, and naturally an ascending channel like this that we're looking for, we're always looking for selling opportunities. This is the nature of this type of pattern, and you're going to see it an awful lot. What we use to go one step further with certain types of patterns is the 90% rule. Now, the 90% rule is absolutely fantastic and unique to Falcon, that we've realized that with these corrections that we identify, when they break impulsively, so you're going to see impulsive candles on the break, we have a 90% probability that we will go to the beginning of the correction. Why is this important to us as a trader? It means that if we're looking at this structure and we're looking at, let's say, selling opportunities because we know it's a reversal to the downside, what does that do for us? It eliminates any imaginary barriers within this structure because we know we have a 90% probability we're going to get to here. So this is where the ray line really comes in. So in our toolbar that you've configured, we grab our ray line and then we pop it in here. And by doing so, we do this. Let me just remove the price for you so you can see if we're looking at the market in this sense and we're seeing, right, we've broken impulsively, what is the chances of where we can look for a target? Well, if we're looking for selling opportunities, we know the 90% rule is proven to be within our favor. So then rather than setting targets here or certain areas that you think price may stop at, we have a 90% probability it will go to the beginning of where this correction started. And that is such an important bit of information that is your true edge. And as we play out within the market and speed that up, you can see us starting to move right to the beginning of the correction. This is normally when price either rejects or starts to create different types of corrections, or we will see a very, very big impulse through. So what we do in this type of situation, we look at the price, we see if we get any rejections and see if we respond to any price. And then at the same time, we make a decision to either set profit targets or we look at the structure for further development. But that's how these patterns play out. And as you're going to see now, we move into another ascending channel. And as this ascending channel develops, notice how it's the same structure, it just has a slight different angle to it, but it's still the same nature. And that's what we're focusing on, how simple it is. You're going to have different variations. And again, to the beginning of the correction to either go lower or it's when it starts deeper corrections. So what we've found in these type of situations is where we can really take advantage of the market. So let's speed that up and we can see how we've moved off. So this is why this is good for profit taking areas. As you can tell, if you're selling here, taking profit, selling here, taking profit, we're using the 90% rule in our advantage. So that is the ascending channels and the descending channels. And what a great exercise to do is to go and pick any currency pair because you've got your trading view configured, you understand all the elements so far. Pick any currency pair and find the ascending channels and the descending channels and apply the 90% rule for yourself. Because what is really going to have that game-changing psychological shift in your mind is you seeing it for yourself. It's all good me showing you on a few charts, but what you're going to see is time and time again, this is how the market works. So do that for yourself and it's going to build immense confidence when you're trading. So that's how we utilize our overall ray lines. We're really looking at the beginning of corrections to see as inflection points, is price going to reject in that area? And at the same time, what it does is it allows us to keep things clean rather than putting a big support line all the way through price, which is just not necessary, because what is most reliable is the current price action. That is the most important bit of information. Now let's take a look at a few other patterns, which is the double top and the double bottom. What you're going to find within the double top and the double bottom, sometimes we have something called a triple top and a triple bottom, and then you can go as far as quadruple, etc. But the common term that we see is the double bottom and double top. It's very reliable within structure and price, and it often repeats itself very often. So let's look at that. So firstly, let's look at the double top. What we're really utilizing here again is the ray lines to identify when price rejects and it pulls back up and rejects again. So it gives us this overall double top type feel to it. By understanding how this pattern works and using the ray lines, it's keeping it very clean. So let me zoom in here. What we're looking for is building a case of evidence with the nature and the structure. So notice how we looked at things like the bear flag. In this type of situation, what you'll find is patterns within patterns. So if we're looking at the double top, for example, at this double top, what would really help us is not just the nature of the market, is potentially a continuation pattern. So notice how within this area, we break down and then we actually form a 6 to 8 hour flag, like I spoke to you about. That with flags, sometimes you're going to get slightly bigger ones, and sometimes they're going to be 6 to 8 hours. So in this type of situation, we're looking for a reversal because we're at the double top, and we also can add another layer, the fact that it has a continuation. This just gives us added confidence to take the trade and building those cases of evidence. And the same way that we look at double tops is the same way we look at double bottoms. So this is the overall bigger scoop of the double top. But what we also have with the double bottom is this. So we've got that overall scoop of the double bottom, and the same exact thing applies. If we're looking for price, we're looking for these type of areas to either take buying opportunities or selling opportunities. And notice within this double bottom, what we actually have is a double bottom within a double bottom. So what does that look like? Whenever we have, and this is a great thing to write down, and I hope you're taking notes as you go along, whenever we have a pattern within a pattern, our probability of the trade is increased. So when we're looking at something like this, we have a double bottom here. As you can see, 1, 2. But this is the overall bigger double bottom. And then what we actually have is the same exact thing. So let's look at that a little bit clearer. So notice how we have a double bottom here. At this point, we wouldn't know that price has done this. But what we can see after that is that we've got the double bottom there, and we've got the obvious scoop, and we actually have another double bottom within a double bottom. So looking left and understanding the price behavior, that what did it previously? Well, we got a double bottom here, and this is the overall scoop of the double bottom, and then we have a double bottom within that. That's just giving us added confluence and added confidence to the trade. Not all the time we're going to see that, but in this type of situation, absolutely looks absolutely fantastic. And this just gives us an indication of where to do that. So when we get things like triple bottoms and triple tops, it's the exact same process. So what you're really looking for in the charts, and again, I recommend you doing that on as many currency pairs as possible, is seeing where these double tops are and double bottoms and triple tops and triple bottoms, and seeing how they react. And if you can add another layer of confidence and see any kind of continuation patterns that are near the top of the double top or the triple top, that's just going to give you another layer. So as you can see, what we're really doing here is we're building a case step by step and seeing, is there any more that we can add to that trade and really make that probability increase even higher, which really does give us our true edge within the market. So now that we've got our double top, we've got our double bottoms, and you understand how that truly works, let's take a look at a few other patterns. So I want to now move on to pound yen and give you a great example. So one thing that we do within the markets is understand the true behavior of price. And certain types of pairs have different characteristics and they have a different behavior. With pound yen, what we've noticed is that we get a lot of head and shoulder type patterns. So how do they behave and what do they look like? So let's take a look at that on pound yen now. So now let's take a look at pound yen. So firstly, what we're going to start off with is head and shoulders and inverse head and shoulders. So what do they mean? So head and shoulders pattern is another reversal pattern that we look at that generally gives us very, very good reversals. Now we can look at them across all time frames, such as the monthly, weekly, daily, 4 hour and 1 hour. What we found in particular with pound yen is on the 4 hour and the 1 hour, they're very, very reliable and they happen pretty often. The inverse head and shoulders, however, as you can probably already tell, is just the opposite. So it's just that pattern flipped upside down. So let's firstly start off with pound yen as the head and shoulder pattern. So on pound yen, what it will look like is this pattern here. You're going to see price give us a corrective left shoulder, and generally we get a move up, it impulses back down, and then we get another corrective part here. You're going to see these obvious, some are clearer than others. And then what we are looking at is taking this on the break of the pattern. We're looking to sell on the break of the pattern. Sometimes what you're going to get within head and shoulders is a move like this, and you're going to take it on the break, and you can either sell it on the break or you wait for the breakout and then it comes back to retest it and then it heads lower. A lot of times in this situation, as you can see within here and you can see within this one, and it's something that's very unique to Falcon, is that we don't always get that retest, and we don't need it. It's not necessary. And what you'll find is a lot of people miss the big moves because of that. They're always waiting for a retest or a pullback within the market, and the market's just going to do what it does. What we need to understand is the possibilities within the market and how can we capitalize either way. And that's really what is unique to Falcon. So by taking these head and shoulder patterns, again, look at the charts and see if you can spot as many as possible and draw them on as an exercise. So now we understand the head and shoulders pattern as a selling reversal. Let's take a look at the overall inverse head and shoulders. So on the flip side, you can see the inverse head and shoulders here. So very clear. This one is actually even clearer. So we have our left shoulder, our head, and then our right shoulder. Now, by looking at that pattern, we're looking to take it on the break. So imagine this. Imagine if with these patterns, which is where people really get confused and they get it wrong and they miss out on opportunities, they're always waiting for the break and the retest and then to take it to the upside. What you can clearly see within both of these ones is that, and you're going to see this yourself as well, is that we don't get that retest. So what we've figured out within Falcon is actually taking them on the break is far more reliable. So we can see the head and shoulders pattern play out. Generally, what you're going to have as a rule of thumb is for a target, you're going to measure from the head to the neckline like this. Very easy with your trend line tool. And then if you place that above, that is going to be a minimum of where price will go. It will generally move up or move down the same distance that you can measure from the neckline to the head. So in this type of situation, it can go a lot higher, but that's just a minimum to give you an idea. If you're more of a short-term trader, you may be looking to set profit targets. So the same way we would measure this one, we would look at it like this, as this is a minimum from the break. And as you can see, it pretty much rejects in the same place. And this one, it didn't really go that much further. So by understanding little bits of information like that is absolutely crucial. But look at as much head and shoulder patterns as possible. What we've utilized in this situation is we've actually combined a few things. So notice how within this pattern, we actually not only just have the inverse head and shoulders, but we have the double bottom, and it gets even better. We have the double bottom, and then we have the impulse up, and you guessed it, the correction. So we have the impulse and correction from the breakout. All this does is just give us another added layer of confidence within the market that not only do we have the inverse head and shoulders as a reversal pattern to the upside, we also have a double bottom in pattern, and we have a continuation pattern within the pattern. When you have a pattern within a pattern, the probability has increased. And you can see exactly why, with the momentum of all of these added layers, is why we had such a bigger impulse to the upside. This has given us an edge within the market by understanding truly how these patterns work. So head and shoulders is something that we see not too much, but when it happens, we can utilize them within Falcon. What you're going to notice more so is things like continuations happen a lot more, and ascending channels. And moving on to an ascending channel type nature, let's firstly look at a rising wedge. So a rising wedge looks very much like an ascending channel. They do have slight variations, which is what I said. What is more important is the overall structure. So these kind of channels, they can kind of get mistaken sometimes for ascending channels and rising wedges. They look very similar. Sometimes you're going to have them very, very tight like this. But in all honesty, guys and girls, the most important thing is just to understand the nature of this pattern. You're just going to see a very ascending nature like this, and then a breakdown. As you can see in this type of situation, exactly the same thing that you would do with a 90% rule. You can see that we break down, 90% chance that it will get to the beginning of the correction. And as you can see, it moves up. So it happens a lot, guys and girls. You're going to see this for yourself, and it's such a crucial bit of information. So by understanding the rising wedge, it has a very, very similar characteristics as the ascending channel. So treat it the exact same way. But what you're going to find with wedges, sometimes they're even tighter than this. So you'll have price like this, for example, rising, and then you'll have this like that. So you'll have a slightly tighter channel. So the same type of formation, it's still an ascending channel, but it's got more of a wedge type feel to it. And that's exactly how it is. It's very, very simple within the markets. People normally overcomplicate these type of situations. The structure is the most important thing. That's really what's going to make you the percentage. And in the flip side, we're looking for reversals for buying opportunities with the falling wedge. So the same thing applies. And as you can see, this has more of a wedge type feel than this one. It has a slightly tighter angle, but it's the same structure that we're looking at. So this is something that I want to hone in on a lot to make sure that nobody overcomplicates that type of situation. So now let's look at this falling wedge. So similar type of characteristics. And what do we have here? So this is really building a case utilizing the higher time frames as well. So with the falling wedge here, we also have the double bottom, which is absolutely fantastic. We have the descending nature. We have the reversal falling wedge. So we're looking for buying opportunities. And we know as a minimum, we're going to get us to the beginning of the correction here and potentially a lot further. As you can see, played out exactly as we expected. Now, this is actually one that we looked at in the later months within Falcon. And we was looking at this particular trade in the webinars, and these false breakouts, they happen an awful lot. And the reason why I wanted to mention that is because the term that you may have heard before is, what is a false breakout? Generally, all that really means is that, let's say that we have a ray line here and we're looking for this to reject. And as you can see, price goes a little bit further. And this is an important part. Price goes a little bit further. And what generally people do is they see these lines as support, as if they go lower, they're broken. And what happens is they break and that support's broken. And if it comes back up for a retest, that will be the new resistance. And this will be previous support. What we've figured out within Falcon is that that's not true. What's more important is actually the nature of how it breaks. So as you can see in Falcon, when we're looking at this type of correction, what we're actually looking at is the nature of how it breaks. So we're watching this pattern overall and seeing that this is very corrective. This is a falling wedge. So even if it breaks, let's say this support, it's very likely that this is going to be a false breakout, get people caught on the wrong side of the market and on the wrong side of the pattern, and actually break to the upside. This is another thing that you want to write down, and a very crucial bit of information that really gives us the edge within the market. A very simple detail, but how it breaks the support or a trend line is more important. And what we can actually look at here, if we zoom out ever so slightly, which is why this was such a fantastic trade. Let's go to the daily chart. When we go to the daily chart, you can see the overall move, and this is where people fail to look at the bigger picture. Notice how we're looking at impulses and corrections. This is very much the impulsive phase. We can see that this whole move is just one big correction. So in fact, what you can see is here is the impulse, here is the bigger correction, followed by the impulse as expected to the beginning, which is here at the double top. So as you can see, these patterns repeat themselves on a monthly, weekly, daily, 4-hour and 1-hour basis, and identifying them is absolutely key for your trading. So as you can see, this really is the matrix. So by really building a case of evidence with the multi-time frame analysis, with everything you've just learned, you can see how powerful it is. We've got the falling wedge, which is perfect, but the fact that we have the double bottom and we have this as the overall corrective phase to then move to the upside impulsively as we expected. So absolutely fantastic. And as you can see there, working out perfectly. So what I would encourage you to do now is to make sure that you're looking at as many of these as possible and seeing how price is behaving with these. By drawing out these patterns in your journal and drawing them out on the charts, it's going to give you so much more confidence within the market. But before we finish up with patterns, I want to show you one more example of how powerful they can really be. So when looking at these corrections, they can be very, very powerful. So notice here we have a pattern within a pattern here. So this is one that we call within Falcon for absolutely weeks. We was looking for this overall structure and how powerful it was, and created some of the biggest returns within the community to date. So let's take a look at that. So notice the overall structure that we've drawn here. And now we understand the phases. You can see that very clearly. Firstly, this is the impulsive phase. This is the corrective phase. This is the impulsive phase, and again, the corrective phase. So now we know what phases we're in. You can see how by looking at this price, not only is it an ascending channel, you guessed it, you can see the overall ascending nature to it. it also comes from an impulse. So we can see it not only as an ascending channel, which is a reversal to the downside, we also have an impulse correction, big bear flag continuation to the downside. So what does that mean for us as a trader? Well, we're looking at this on the daily, and what we will be doing is we'll be popping on our ray line because we're utilizing the 90% rule in this type of situation. So what we looked at within Falcon is this. Let's go back to when price wasn't there. So by looking at this in this area here, we're looking at the current behavior of price, and I'm going to delete this so you can see. We're looking at the current behavior of this as a big continuation pattern. We have an ascending channel and ascending nature. We have our parameters with this structure, keeping it as simple as possible. And what we actually have before we break, as you can see, is we have our reversal ascending channel, we have our continuation. So we have the ascending channel, we have the impulse, correction, impulse, and the start of the correction here before we break. The 90% rule triggers in, so we know that if we break impulsively and we get an impulsive close on the daily or on the weekly here, on this high time frame structure, we have a 90% probability we'll get at least to the beginning of the correction. So what it means for us is that we can have a solid target. What often people do is they cut themselves short with their strategies because they think that there are imaginary support lines, imaginary barriers, when in fact what is proven is pattern identification is going to give you the highest risk to reward and be the most sustainable longer term. And that's what we absolutely love within Falcon. So let's see how that plays out. So as we move to the downside, we broke impulsively. As you can see, we're at the 90% rule and we break off on that double bottom. So as you can see here, as we correct, we actually go a little bit lower, we break through. Remember, this is just the minimum, we can go a lot lower, but these often give us very, very good points for targets. As you can see, holding through all of this price can sometimes be quite daunting when you've got a lot of profit on the table. So what we found is these are good profit taking areas, and we let the rest of the correction happen before we look to continue again. So a very, very important part within understanding how these patterns behave. And what you're going to see now, you're going to see it a lot within the charts. You're going to see impulses and corrections everywhere within them. Just like I mentioned in the previous, that we have a correction here, but notice how we still have impulse, correction, impulse. We have them everywhere. And within the same sequence, we have the same thing. So when we even draw on this correction here, you can see we've got our impulse, our correction, and then our impulse. And then we have our ascending channel, and we have our impulse down as the reversal. And then we have our impulse, our correction, and then we have our impulse. And then we have our impulse, our correction, and our impulse. And now we're starting to find new structure within here. So as you can see, on a consistent basis, how often these patterns behave. I mean, even if we look left, we can even see here again. So we have our impulse, our correction, our impulse. All the time, guys and girls within the market, we're getting these patterns. So pattern identification for me for years, and I've been in the market 9 years now, has been the biggest game changer and the biggest breakthrough for me. And I found it to be so very reliable. So by adding these key components that you're learning within this episode and then this overall structure of the Falcon principles and strategy, you're going to see how powerful it really is. So what happens next with patterns? So you understand the patterns, and you're going to see as you do the exercises for yourself how very reliable they behave. So what is next? And that comes in the form of evolving. What you're going to find is in the next section is evolving patterns. So some of these structures, they can look like particular patterns and then sometimes slightly evolve into other patterns or just bigger versions of themselves. So that's what we're going to go into next and show you how to react and how to deal with them and what is the main thing to look out for when and where to actually evolve these patterns. So I hope you've taken plenty of notes. We've gone into much more detail in this lesson as it's very much needed. But now let's look at evolving those patterns as your next layer. So now we've built on some really key important components of the Falcon strategy, let's get into evolving. So what does that actually mean? Evolving with the market or evolving with your analysis? So when you're trading, it's important not to just be very strict on one way of thinking. Sometimes we're going to need evolve. Sometimes particular patterns that we've looked at have evolved into deeper patterns or extensions of patterns. And it doesn't mean that the pattern's wrong, we just may have an evolvement of that. And by understanding how they evolve, it keeps us 10 steps ahead of the market. So let's take a look at that. Now, this is a term you're going to hear in nearly every piece of the Falcon content, and it really just refers to taking that message from the market and making just small adjustments to your analysis along the way when they're necessary, of course. What we do is we utilize the trend lines and the ray lines that we set up in the trading view. So in your toolbar, we're utilizing these trend lines and ray lines to form that market structure. But then when price develops and it evolves, and it begins to advance into new structure, we are prepared ahead of time. So you always have that clarity. And what it does, it also allows us to keep our charts very, very clean. And what we'll do along the way, we will either be deleting or moving old analysis. And what it's done is it's keeping our charts super clean and relevant to the current price. Rather than taking trend lines from, 1984, we've got our trend lines focused on what is the most reliable form of price action, what is the most recent form of price action, and that is the most important part. But now let's take a look at how we actually evolve structures and what we actually look for. But more importantly, let's take a look at how we use the nature of the market to help us evolve these patterns and structures. So now let's take a look at evolving and what does evolving really mean. So within the market, what you're going to find is that the market is always looking to progress, and natural progression within the market is for impulse, correction, impulse. So let's look at that. So natural progression in the market would be to impulse, correction, impulse. Now, sometimes within the market, what happens is that we draw on our trend lines and our patterns, and what often strategies look at is the fact that if a trend line is broken, they take that as absolute, when in reality, that's not how the market works. What the market is proven to do is evolve. And what we do within Falcon is that we're always evolving. So let's take a look at that. Let's say, for example, we had a trend line here, and you can see we have our impulse, we have our correction. It wouldn't be unnatural for the market to correctively break the trend line in the same form of the pattern and then still move to the upside. What would happen is it would look like this. So if we take a trend line here, for example, and we have our impulse, and then we have our correction. When we get our correction on the trend line, what often people do is they see the trend line. If that breaks, that means that we're looking for selling opportunities. Not necessarily, because what we can look at is this. We may get our impulse, our correction, we may get our impulse, and at this point is when we normally get our next correction. And then what people are looking for is they're looking for a trend line bounce. And as we get here, they're seeing, is the market going to break for selling opportunities, or is the market going to bounce to the upside? When in reality, not many people have figured out the fact that if it moves out correctively like this, then there's been no real progression within the market. All that means is it's created an extension of the patterns. That's what's really happening within the market. And then what we do is that we adjust. So if we see price correctively move out of a trend line, that's the question that you want to be asking yourself. So it ties in with the nature. What we're saying is, what is the nature of the market telling me? And has the market moved out impulsively or correctively? And if it's moved out impulsively, then we know that something's changed and we're looking for downside movement. If it's moved out correctively like this, then there's been no real progression, and it's likely to still continue in the direction of natural progression. Impulse, correction, impulse, correction, impulse, and continually moving in that direction. What we would do in that situation, after we've had that impulse, we would adjust the trend line. And then would we leave our trend line here? No, we wouldn't. What we would do to have the most reliable form of price action is move it to the last two previous touches. So you can see as we evolve with the market, we start to evolve with the structure, and then we start to see the patterns become clearer and clearer. So we've gone from natural progression of an impulse continuation, and we've actually evolved into an ascending type channel, an ascending type formation. And this is why when you're evolving with the market, it keeps you 10 steps ahead, because you're not waiting for price to do something for you to figure it out later down the line. You're always evolving with the market. Now you can evolve on all time frames, so it doesn't matter whether you're on the daily, the 1 hour, the 4 hour, the weekly, or the monthly. You can always evolve with the market. So now that we understand how to evolve with the market, let's take a look on the chart of how that would look like and how we could progressively tie in all the key components that you've learned so far. So let's take a look at this on Euro Yen. So if we focus on natural progression within the market, and we're looking at this area here, we have our impulse, our correction, our impulse, our correction. And as you can see, we then move into a correction, just an extension of a correction. So if we look at that in the form of, let's say, for example, we was looking to take this to the upside. So we've had our impulse, we've had our correction, we're looking for buying opportunities within here, and we start to develop a trend, as you can see. As we develop that trend line, I'm going to go into the lower time frame so you can see this more. As we develop that trend line, you can see we've evolved with the market. Previously, we would have had the trend line up this touch here. Notice how interesting this pattern is as we look at natural progression. So if we're looking at the market, we're seeing the market impulse up and it starts the correction. So we're getting this correction of continuation at this stage here. But look what happens. We actually start to create a descending channel. So from the patterns that you've learned, you can see that if there's been no real progression and we've moved out of the trend line correctively, you can see this is just an extension of the pattern. And this whole move is still a correction. What most people would see is that it's broken the trend line and we're looking to sell this, when in reality, that's not how the market works. The market is always looking to progress. And as we start to move up and we impulse above, especially above these highs here, we can see that this was actually just a correction to move higher. So then what we do is we then evolve with the market. So by sticking this trend line out as far as it can go, we're then going to use this as a guide as we progress through the market to see that, is this going to act as a guide for another continuation? Because remember, we're looking at the market to impulse, correct, and move higher until it shows us otherwise. So in this type of situation, what did we actually get? Yes, we broke the trend line, but we broke it in the form of a correction. And because we broke it in the form of the correction, you can start to see that we have an impulse correction to actually move higher. Where most people would see this as a break of a trend line to come to the downside, we will see that as an evolved progression. And as we move the trend line in, you may be asking yourself, well, do I still leave the trend line in here? What we actually do to have the most reliable form of price is we like to focus on the most recent major two touches within the market. So what we would do in this stage is that we understand the market didn't actually give us any impulses to the downside. We just correctively moved out. So that's why we've evolved the trend line. And then we start to evolve this. So as you can see, we now have the most recent price action. And this is very, very important because we can start to build a case of evidence of what kind of pattern is forming. So you can see how we've gone from natural progression of impulse correction, expecting the impulse out in the form of a reversal channel. So we're starting to form that ascending channel. This is where it gets interesting because we're starting to figure out that the real true structure is forming and there's a potential reversal on the cards. But at the same time, we can still take advantage of buying opportunities, but understand that this may be coming to an end for a reverse. So this is how we play it. We're looking in this area to see that is there any reversal patterns. And what we actually start to get, if I go to the daily chart, you'll see this even clearer, is we start to get more of a correction. So notice how we've had our impulse and our correction, and in this area, we just start to form another correction. No real progression within the market, as you can see. So what we would look to do is as soon as this started to move up, as you can see, we would then start to evolve with the market. We're evolving always with the market. And as we evolve with the market, you can see that we want to go with the most recent touches. So we drag our point from this area to the most recent touch, which gives us our truest form of the correction. And by doing so, we then adjust this part. So now we've got our bottom trend line. We're then evolving with the market and moving up accordingly. So you can see, look at what we've done here. We've gone from an ascending channel that was previously here that we formed. We've now got another ascending channel. So can you see how structurally nothing's changed? It's just given us an extension of what's actually happening within the market. And we can actually take that one step further and go to the most recent touches. So it still gives us a slight different degree, more of a rising wedge type formation, but it's still an ascending channel. And it's important to understand that you don't need to be that picky with the market, which is why I mentioned in the patterns that you have ascending channels and you have rising wedges. Sometimes they're going to look very, very similar. So what we do now, by understanding that this structure is unsustainable to move to the upside, very rarely you'll see an ascending channel like this and then it moves to the upside. What you'll see is an ascending channel, natural progression is to actually move to the downside, creating the 90% probability rule that you've learned at the beginning of the correction. So now let's take a look at this particular trade. Where is the beginning of the correction? Easiest way to identify that is to separate it in terms of patterns. So what we can actually do here is see that, well, we've had our impulse, there's a correction. So that's a pattern that's separated. We've had our impulse, and then here is our correction. We can see that here. So then we want to move our trend line to the most recent form of price action to see what is the most reliable. And then we can bring that in. And you can see this is actually the current structure. This is where the beginning of the correction started, because we've gone from an impulse, correction, impulse, a correction, and then we formed an ascending channel. So the natural progression to the upside didn't happen, and then it started a reversal channel. So we're looking for selling opportunities. So then what we can do is pop on our Rayline tool. So imagine that price hadn't happened yet and you was looking within this area. We've been looking at this in Falcon for a long, long time and tracking this ascending channel. And you can see that within our webinars. When you're looking at it, we're looking at price here as this is identified as the beginning of the correction. So by knowing this information and understanding the 90% probability rule, if we break to the downside, it's very likely 90% chance will be at the beginning of the correction. So it makes our targets really easy to set. So as we see that play out, we can see that price moves exactly where. You can see it just rejects off of there and starts to create a slightly deeper structure. So from a profit target potential, there are ways in which that we get into the market, which you're going to learn with the entry types at the top of the structure, within the structure, and on the break of the structure. And by understanding when these patterns break, the 90% probability rule will come in. By understanding that bit of information is very crucial. And what you're doing along the way is that not only are we evolving with the market, but we're using the key components of the 90% probability, the reliability of these ascending channels, and piecing everything together. So what I recommend you do now, guys and girls, is make sure that you go onto the currency pairs and you treat this as an exercise. And what you want to do is you want to look at particular price on any currency pair and see that when something breaks a trend line, ask yourself the question, and you should definitely write this down. What is the nature of the market telling me? Is the market corrective or is it impulsive? And if we see that the market is corrective and it broke a trend line or a pattern correctively, then there's been no progression and then we can look to evolve. And then what we're really looking at is the most recent two touches to have the most reliable form of true structure. And we've seen this 90% probability rule play out time and time again within this overall series, and you're just going to see it time and time again. And once you see that on a subconscious level, you're going to build a whole new level of confidence of why we're looking at target areas for these particular patterns, because they play out on a regular basis. So I hope you've enjoyed understanding how to evolve your patterns and trend lines, and you realize that the market is forever looking to progress. We just need to understand what kind of evolved structures they're within. And as long as they keep evolving, you can see the structure didn't change the whole way. The angle of it changed. And eventually the market progressed to the downside, exactly how these patterns play out. So do that as an exercise, and I look forward to seeing you in the next section. So the next part that we want to focus on is our actual entry types for us to actually get into those positions. Now, an entry refers to how you decide to enter the position in the market. Once you've performed your analysis and you've outlined the potential position and the point of entry, as a Falcon student, you're going to have two options, which it takes us nicely onto the next point, which is the entry types, of course. So let's take a look at what they are. Risk entries and reduce risk entries. So we keep it as simple as possible of how we enter these positions. Now, there are two options when executing a trade, but the general rule of thumb is risk entries come more often than not, and they come as a slightly higher risk to the potential loss. But in return, they offer a bigger reward, also known as risk to reward. With the reduced risk, however, the entries are essentially, they allow you to wait for extra confirmation of taking the trade. Before you enter the trade, it allows you to have a little bit more time before you actually get into the position. But at that comes, you're sacrificing a little bit of the risk to reward. So by getting it as a risk entry, it's more profitable, but at the same time, you might take a few more losses. But then at the same time, when you're taking a reduced risk entry, you're waiting for more confirmation. You're going to see as a trader, as your own personality and your style develops within Falcon, you're going to see what suits you better. Now, as you progress through the foundation series and the course, and with the community as a whole, you're going to realize that risk entries, they're not that risky. All it just means is the current pattern that we're looking at, for example, it may not be confirmed yet. And sometimes you're being a little bit more ambitious, but then it does come with a bigger reward. But the whole point of being a great trader is understanding that and being ambitious and understanding that all of the vigorous hours and hard work that you've done, you've seen these patterns play out time and time again. So it's perfectly fine taking these risk entries. Now you're going to develop the skill set. You're really going to understand how the market allows you to capitalize on massive risk to reward trades. And it's so rewarding after the hours that you put in that you see this come to light. You figure out your kind of personality and your style with trading, and then you stick to that. When you combine that with your trading plan, the clarity is fantastic. So now let's take a look at some entry types on the market. Let's look at what did the reduced risk entries and the risk entries actually look like? So let's take a look at that now. So now let's take a look at our entry types, stops and targets, and then build on that by learning how to scale into the market. So firstly, what we're going to touch on is two types of entries that we predominantly use within Falcon, which is risk entry and reduced risk. Now, what you're going to find is that within the Falcon strategy, you're going to find your own particular style, what you take more often. So some of you may take more risk entries, some of you may take more reduced risk entries. And this is what is really unique to Falcon, is that it caters to your own personality and what you're more comfortable with. So let's go through some entries, show you how we scale in the market and how simple it really is, and then how we really use our stops and targets. Now, with our stops and targets, we're going to go into more detail in the later episodes when we look at placing the particular trades with the more intricate details of exactly how to place them. But we're going to touch on that now so you can see where in the structure that we utilize them and how simple we keep it. So let's take a look at USD CAD and build a case of evidence of why we have the entry type. So you're going to see how we link in everything that you've learned so far. So firstly, when looking at this overall bigger structure on the daily chart, we're looking at the overall bigger impulse, correction, impulse. That's what we're anticipating, because we're seeing this whole move as a big bear flag continuation. Not to mention it has the ascending nature, and we know that this is a reversal. We also know that if this breaks impulsively on the daily or the weekly, it has a 90% probability that we're going to get to the beginning of the correction. So this is where our target comes in. So what we're always utilizing within Falcon is the current structure for target. We're always looking for targets at beginning of corrections or at double bottom areas, i.e. this would even be a bigger double bottom, as it's a good profit taking area. So what you're going to find is with your targets, do I always set profit targets or do I wait? Well, the best way to do it within Falcon is that if you can be by the screen, you want to be paying attention to the current nature of the market and what it's telling us. If we're getting any reversal channels, let's say some falling wedges that you've learned, if we get any descending channels, then we know that's a reversal type territory. So it's very likely that price is going to potentially break to the upside. So we'll look to be locking in profit or manually closing that profit. Now, let's say, for example, that you was in the particular trade and you're in profit, you're selling it from up here, and we get around this area and that you need to go to sleep. You're going to find that with trading, it's got to be suited around your routine. Because you know you may be at sleep and price may hit the double bottom area at the beginning of the correction, it's okay in those type of situations to set profit targets for those reasons. So just remember, don't be too rigid with how you set targets. Normally take a message from the market and you can look at the beginning of the correction as a perfect target area. So now let's take a look at a couple of entries. So firstly, what I want to start off with is some reduce risk entries. So the idea behind reduce risk is after we've had a confirmed break of a pattern. So what you'll find is these are continuation patterns after the break of a particular trend or an ascending channel. So what we generally get, say for example, something like this. So we may get an ascending channel, which we know is a reversal, and we will have a break of that. So we'll have an impulse out of that, and then we'll start getting the flag, either 6 to 8 hours, potentially sometimes a bit longer. And then what we look at in this type of situation is an entry on the break of the structure. Generally, what we like to do is place the entry 4 to 6 pips below the current structure. The reason why this is important is it allows any room for spiking. So sometimes, for example, if you set an entry below the flag and it's very, very tight to the current price, what will happen is we could get little bits of spikes and you could be tagged into the trade and it could move up to the upside. So the advantage is sometimes you're going to set entry orders and the price may not break down and it might break up or form a larger structure. And if it does that, you're not in the trade and then we reassess the position. What happens with traders is they set their entries very, very tight to structures. They get tagged into positions and they take unnecessary losses. What we've figured out in Falcon, that generally if you have it 4 pips below the low and you just factor that into your stop, it makes it far more reliable. So now let's take a look at that on some particular entries. So if we look at the particular entry here, so with the bear flag continuations, very, very simple and something that's commonly used. And it's exactly the same thing for a bull flag, same principle. So within this strategy here, we're looking at this as the top of the risk. So if we look at this current price structure that we have within this section, you can see we have 1 and 2 here. So this is the overall top of the flag. So when we're looking at these trades, what you'll generally have at the top and at the bottom of a structure, you'll have risk entry opportunities. Top and the bottom of structure is personally my favorite for my style and for a lot of people in the Falcon community. So what we'll be looking at the top of the risk entry, at this stage, nothing is really confirmed that we're selling to the downside. We need some moves that really impulse to the downside. But at the same time, we can see this is at the top of the structure. So what's going to happen is you're going to be able to get in at a very good entry. You're going to have a great stop and it's going to give you good protection. So it's very, very common to be taking risk entries at the top or at the bottom of a particular structure. So if we look at this entry here, you can see that we have the bigger flag. We've actually broken out of an ascending channel. So we have the ascending channel here. We've impulsively broke out, and this is actually a continuation. Now, the reason why this is a risk entry position, because we're trading within the pattern. We're taking it on the third touch at the top here. We're entering as a risk entry at the top of this structure of this pattern. If we was taking it as a reduced risk entry, then we'd be taking it on the break here. The reason why we wouldn't take a reduced risk entry is because what it would mean is if we took that on the break there, it would mean our stop loss would likely be 140 pips. Now we've covered pips, so you understand that we want to get in as tight as possible, but of course be safe and sensible. When we're having something like this, look at how the risk to reward changes. So as you can see, we're setting our target with this particular trade at the beginning of the correction here. So we know this is our target. We're utilizing the ray line tool again, and you can see the risk to reward is 7.56. So what it does is it's working it out for you based on you risking 1%. So you know in this type of situation, if you took that trade as a reduced risk on the break, it would be 7.5 to 1. So you're taking a 7.5 to 1 trade. Now, however, if you're taking a risk entry because you're anticipating the same move, generally what you'll find in Falcon that a lot of the stop sizes tend to be around 40 to 50 pips. Within risk entry, it's normally around 30 to 40 pips. You sometimes can get in even tighter than that. So if you remember the figure, 7.5, That's the risk to reward. Now let's look at it as a risk entry position, and it really changes the game. So the same principle, you're anticipating the same move, your target is in exactly the same place, and then what you're doing is getting with a risk entry with about 40 pips, because it just has to be above the current structure. Now, some of you can be more conservative. If you want to be on the safer side and put it just above the high, you can do that as well. It's personal preference of style. So as you can see, we're just above the high of the recent price there, and the target is now changed to 20, nearly 21%. So as you can see, it's a very big difference by really understanding how to trade the patterns. Now that's a more conservative. The majority of people within Falcon would have been on with about 40 pips. So as you can see there, nearly 30% on that first move. And by understanding the probability, how we would look to take this trade is by taking it at the top of the risk entry structure. And now that we're taking this at the top of the risk entry structure, let's take a look at that. Being as tight as possible, we know we've got about nearly 30%. It showcases how powerful that really is. And then what we would look at the whole way is, firstly, our first target will be about 15%, because we want to see how it reacts to the overall trend line. And then what we'll be doing at that stage is seeing how it reacts. And as we can see, we actually get another continuation. So it gives us a good indication this is going to break lower. And then once we see that impulsive break, guess what? We know that we can hold that for the longer term, because of the 90% probability kicks in. That is our real competitive advantage, because what most people will do, and the reason why they fail, is a lot of people within the trading world and space believe that the reason why they're failing is because of their losses, when in fact what they don't understand is that the reason why they're actually failing is because they fail to capitalize on a move like this. What they do is they get in a couple of trades, they may bank 3 or 4%, and then that's it. And then within Falcon, we will take advantage of maybe not every single position it presents, but the majority of them. So we're able to bank in the region of 20 or 30%, and most strategies may hit 5 or 6% if they're lucky. But then what happens is they'll take a few losses and undo their hard work. And then what happens with us is sometimes we'll take a few losses, because losses are always going to be there. But because we capitalize fully on the move, it's our wins that take care of that. And then what that does from a psychological aspect is that it takes away the pressure of trying to be perfect. It's never going to be perfect. Losses are always going to be there. But actually understanding how to capitalize on the full move, that is when your skill set is on another level. And that is what you're learning now. So this is seriously very, very powerful. A crazy amount of potential. So pretty much 30% on that target. So now let's take a look at stops and targets. So what is the stop loss? So the stop loss is the tool that we use to make that risk management possible. So when you place a trade, you have the option to place a stop loss. Now the stop loss, it allows you to be taken out of a position when the market moves in the opposite direction against your trade. So what that means is the two main scenarios of a stop loss would fit are this. Number one, you've been entered into initial position, however, price has turned around and it's hit your stop loss, and it takes you out for that full 1% or 0.5% loss. Number two is that you have a position running in which that you're in profit by, let's say, at least 1 or 2%. You can now move your stop loss towards current price, securing profit. If the stop loss is now hit, then you're taking out of the trade for profit. So let's say, for example, your position was running in 2% profit, and then you moved your stop loss up to 1% of profit. That means that worst case scenario, that if the market price turns to the downside or to the upside against what you're doing, then you'll be taking out for a secured profit. So now let's take a look at target. So what is a target? Is it just an outlined area in which that you set an order for the broker to take you out of that position? Now the broker will execute that order for you and close that position for profit in an area in which that you set. Now these targets can be key for when you're not in front of the charts or you can't be present. For example, you can set an order in anticipation price of reaching a certain level area before you go to sleep. If price hits that target overnight, you're taking out for the profit. Now utilizing the risk to reward tool on TradingView that you've set up, it will help you visualize and understand that all this means is it will give you a visual understanding of the upside potential. And then the downside is consistently capped at that 1%. So let's take a look at a quick example of a stop loss and a target using the risk to reward tool. Hey guys, so just another quick tip here. Now, as previously touched on stops and targets, there's just something I want to touch on very quickly here as a refresher. So as you know that with our stops and targets and our risk to reward tool, very simply, all this tool means is in the blue area here, you can have this different colors. It's entirely up to you whether you want this green, blue, or red, and I'll show you how to customize that in a second. As you can see, this side is our stop loss. In the green side is our target. So this is where we're actually entering the position in the middle here. Notice how you can see the risk to reward ratio. If I drag this down for my target, you can see that risk to reward increasing. So we've gone from a 4.35 to 1 to then potentially a 6.44 to 1. So as you can see, very, very self-explanatory. But what we've found within Falcon is that customizing certain areas of your chart make it more pleasing on the eye. So something that you may want to try out, and it's completely up to you, personal preference. You simply use red and blue within these sections. It's completely up to you. So if you do want to customize it, all you need to do is double click on here and you'll see this window pop up. As you can see, either your target color, your stop color, you can literally customize it to whatever color you desire. So if you wanted it to go back to red or a slightly different one, you can do that to this color here, and then you click OK, and then you can see it. If you wanted to customize it to a slightly more vibrant red, then you can do that as well. So it's completely up to you, but just another little tip there. So what is scaling in? Scaling in is really the differentiator in our strategy opposed to a lot of FX courses. We understand the true nature of the market and the market sentiment. So what that does for us is we're able to outline areas during price movements that we can enter sometimes second, third, sometimes even 4 times in the same position. But what this does for us is it allows us to capitalize on the full potential of the actual trade and to make some pretty epic returns. Now, you need to make sure that these are executed properly and safely and sensibly, which of course we show you how to do that. But by scaling in, it can sometimes be a bit of a tricky subject and it is quite advanced. However, it's learnable and it doesn't take you as long as you think. But it's important to be aware that we're not just making money or making percentage from our initial and sole trade. Sometimes we're building on those trades multiple times to really accelerate the returns and take advantage of the opportunity that the market is giving us. All scaling into the position is, guys and girls, because people overcomplicate this. It is building on your theory and the position that you have. So how it all works together is, if we're building on this whole trade as here is the impulse, this is the big correction, we're anticipating a risk entry at the top of the structure to sell this to a minimum of this trend line here and potentially look to break. If it's breaking impulsively, then we know the 90% rule kicks in. So by knowing that information, it's very likely based on probability that we will have 2, 3, 4, maybe 5 or 6 entry types all the way down. We already know there's a 90% probability we're going to get here. So why wouldn't we capitalize and add to the positions as much as possible? So that's what scaling in is. So if we currently look at the scaling opportunities that we have within the structure, let's take a look at that. So we also have more scale-ins. So within this area, you can see that firstly, we have this particular trade. This is our bigger trade from the top of the structure. Let me remove this out of the way so you can see this cleaner now. And then we have another entry. Now this is another reduced risk style entry here. So we have our risk entry within the structure, and then now we have our reduced risk entry on the break of the structure. So as you can see with this type of structure, it requires a 100 pip stop. Generally within Falcon, this wouldn't be really an entry that I would take. How I would look to take something like this is if I can get in with a slightly smaller stop, likely to be a risk entry. So although this is a position, this will come down to your own personal style. It still has a great risk to reward in it, and it does come down to preference. But as you can see, still 10% potential, so it's still good. And if we work our way into 1 hour, we can actually see if there's a risk entry potential involved in that particular structure. So as we work our way down, we're looking at that with a structure, and we can see that there is a potential. And how we utilize that is at the top of the structure, we're able to get in here with about a 50 pip stop. So sometimes what you're going to find is it actually gives you more than one style of entry. And if you don't get the risk entry, worst case scenario, you can take the reduced risk entry. So you can see already we've been able to build on that. So this would be what you call your scaling, either scaling in here or scaling in on the break. Even if you didn't get that position, because we have to assume that you're not going to get every single trade. So what we can look at is further on into the move. So let's take a look at that. So as we've got our two trades so far, or let's say you've only got in with risk entry at the top, we can start to see this structure here, a typical another continuation. So this is becoming the bigger move down, and this is just the bigger correction to move lower. So how do we look at taking this one? Well, we have two entries again. So if we zoom in, so you can see here, let's clean this up. If we zoom in, you can see that we have this overall 1, 2, 3, and then we have this ascending channel here. So you can take a trade within the structure. So again, another risk entry trade, and you'll be looking for your stop to be just above. So this would likely be about a 50 pip stop to be conservative. And then our target is the beginning here as a minimum for about 6.8%. And then we remove this out of the way. So as you can see, for that 6.8%, a target here, and then you've got 20%. Now, if we add to this again, we actually have a reduced risk entry. So first we have a risk entry, and a risk entry, all it really means is that nothing's confirmed yet. So in the title, so nobody gets confused, all a risk entry is taking a trade either at the top of the structure or within a structure. And the reason why it's a risk entry is because this pattern isn't confirmed yet. And what I mean by that is if you take the trade here, this could move down, move up, do something like this and still drop, because nothing has confirmed on the break yet. We're just taking it based off of it's actually a setup at this stage. Where on a reduced risk, you're taking it on the break of the structure, but it normally means that you have to have a slightly bigger stop, so your risk to reward is less. So that is why risk entries are so attractive. Now, risk entries don't mean that they're very risky, it just means that the pattern is not confirmed at this stage. But what you're going to learn in Falcon is your skill level is going to get better and better, and you're going to time these a lot better by understanding how these patterns behave more and more. And once you do that, your risk to reward is going to be on another level. And we've seen that in the community. So much progression with understanding how to utilize these. So what we have here, we have entry 1, we have entry 2, entry 3 on the break, entry 4, and now entry 5. We're just getting started. So if we just remove that down here, so even if you didn't get 1, 2, 3, you didn't get this entry either, there's no need to have that fear of missing out anymore, because within Falcon, we have so many entry types and so many ways to get into the market with these risk entries and reduced risk. You're always going to have opportunities, and that way you don't have that fear of missing out, because we actually have an abundance of opportunity. And when we look at that as a reduced risk on the flag, taking it on the break, slightly bigger stop, about 60 pips, because you're going to have this 4 to 6 pips below the current structure. And as you get triggered in with an entry order, so what you're going to be doing with your entry orders, which I explain in more detail when you're showing you how to actually place a trade, you're going to be setting an order to trigger you into the market 4 to 6 pips below the structure. The reason why you wouldn't wait and enter it live is because, as you can see in things like this, look at the size of the impulse. So if you're waiting for this, you're going to be entering here, which then it's too late within the move. What we're anticipating here, guys and girls, is the break. We're anticipating that the impulse is going to take you into the trade. So that's why we take that. And as you can see us scaling in, there are so many entries that we've just built on. So within this one is another 15.6%. And this keeps going on. We had another entry on the break of this pattern here. So this is another reduced risk rather than risk entry. Let's take a look at that. So this one you'd have to have a slightly bigger stop, which is about 90. And then your risk to reward here is still about 5%. So you still have potential. If you didn't get this one on the slightly bigger stop, then you have another opportunity to get in with the reduced risk, which is a slightly smaller stop, about 75 pips. and then you have another 5.5%. Just adding up those percentages, there's nearly 75 to 80% within that move down. Now, you're not going to get every single one of them, but it is absolutely criminal to not take advantage of the abundance of opportunity we have and understand how to really scale into these moves and take advantage of them. Because what's happening within the trading space is you're taking good trades, but you're not capitalizing on them fully at all. And you're not factoring in understanding how price really behaves on these corrections. You're waiting for the market to always satisfy you and do things for you. So now you understand the power and how we can link all these components together and how easy it is to take them. We're literally taking the trades either on the break of the structures or within the top of the patterns, and that's where the risk entry is. To be on the safe side, you have your stop just above the high or above the current structure. So we can't say for sure that, right, your stop loss is always going to be 50 pips or 60 pips because it all depends on the current structure. But we're always looking to have it just above the particular flag or at the top of the risk entry just above the high. And we're keeping it as simple as that, guys and girls. And that is how easy it really is to capitalize, to scale in, and set our clean targets. But what I want to do now is show you a couple more of looking at some risk entry style positions. So let's take a look at a couple more. So here we have the euro over the Japanese yen. Let's take a look at the current structure. So as previously touched on this particular structure that you're familiar with, we have our impulse, we have our correction, looking for that impulse. But understanding within the structure, we can take advantage of buys and sells within the structure while this is forming. So let's take a look at that on the 1 hour chart for entry. What we're going to find is that we take a lot of our trades on the 1 hour chart because that's where our entries are, but we're basing and building a case of evidence on the monthly, the weekly, the daily, the 4 hour, and then the 1 hour is just for precision. So this is a key thing to learn. So by understanding patterns, you can see that we've got a lot of patterns on here that we're focusing on. This is an interesting one because what you're going to learn, and or you may have previously learned if you've been in trading for a while, is that when you've learned trading, you've seen these picture perfect setups, these textbook setups. And then when you go into the market, it's not as clean as what you thought. Because in reality, the market can sometimes be slightly ugly. And what does that actually look like? Well, this is a great example. So let's take this chart pattern, for example. We're looking at this ascending channel at the top of the structure. By looking at this ascending channel at the top of the structure, we also have a double top type formation. So you've understood the double top type formation, and it's a good thing to put in as we're utilizing our ray line tool and keeping this nice and clean. So we have two types of entries. So our first entry, which of course would be our risk entry, that we would be looking at the top of the structure, enabling us to get in with about a 30 pip stop. So like I mentioned, sometimes it's going to be very, very tight, which is perfect. And then we're going to see how it reacts to the beginning of the correction, 90% probability. And then our next target will be the bottom of the structure. So as you can see, by understanding that double top, ascending formation, risk entry structure, we've potentially banked 10% just within this small move. Now, we didn't quite get to the full 10%. Eventually we did, but within this section, you would have closed the position. But we're always looking at the double bottom area for the target and a minimum of this area. So we know by looking at this, our minimum, we would have banked 5%. And we did within the Falcon community. And then what we can look at here is, well, can we scale in? So this is the interesting one. So let's take a look at that. So we've got a risk entry trade and we've got our target here. We're going to look at see how it reacts to the beginning of the correction. But notice that we have a reduced risk entry flag continuation here as well, which just is adding more probability. But if I move this in, what happens? We go straight through the price. So this is what I call about trading the market slightly ugly and learning how to do that. So what this means is that you can see that we're starting to form a clear flag, but the price is going through it, and you don't want to put the price through it because it doesn't make sense. All you do to understand the same structure, all you do is just rein it in a little bit. You're still looking at the same structure, nothing's changed, but you're reining it in so you can actually see what is going on with the pattern. And as we do that, you can see how it means no relevance to put that actually through the price. You can still see we have this ascending structure. What we're doing by reining it in is seeing what this pattern is showing us, and it's allowing us just a few pips below, 4 to 6 pips below, having our stop just above the structure, about 30 to 40 pips, let's say 40 pips to be conservative, and then we have the same target. Our first target is the beginning of the correction, which is 2.6%, and then our second target is 6.5%. Notice how our first risk entry trade, we had a minimum of about 5%, 5.5%, and then 10% to the bottom. Let's just do minimum worst case scenario. Worst case scenario, we've got 2.6 plus our, let's say, 5%. So 5% plus 2.6, we've got our 7.6 as a total. We've got our risk entry trade and then our first scale in. So the scale in is always when you're building on the theory, you're building on the position and scaling into the move. So you can see how an ordinary person may not even get this trade, or an ordinary strategy may not capitalize on the trade. But let's say they did. It's very likely they might make 2 or 3%. And what we bank is 7.6, 8.6, and really capitalize on the move. And that is where the consistency comes, because it's inevitable to avoid losses. You're always going to get them. It's just what we find is that because where we capitalize so fully on the full potential of the moves, when the losses happen, they're a dime a dozen. You barely see them, because if you're up 10% and you take a couple of losses, you're not really going to focus on it. You're not going to really be emotional. It's not really going to affect you. But if you take a 3% trade and you don't understand how to capitalize on it fully, and then you take a couple of losses, you find yourself getting back to pretty much break even. Then you start questioning whether you're doing the right thing, and you start to overthink things, and it's where you go in a downward spiral. So this is where we're really changing the game here by learning how to capitalize fully. So a nice risk entry trade there and a reduced risk, so you understand the difference. Risk entry is always at the top of the pattern, top of the structure. Reduced risk is on the break of the pattern, on the break of a continuation bear flag like this. And as we move on, you can see we get another continuation. So very clean. We've got the impulse, we have the correction, and now we have a reduced risk trade to take to the downside. So the same way we'll be looking to take that is by adding this here like that. So we need a slightly bigger stop just above the structure. So this one at 50 pips. And then our target will be here again for about 3.5%. As you can see in this one, we only got to about 2% in this trade. We're not always going to get the full move, but we would still be targeting this double bottom area, because that is where it's likely for people to take profit. We did get there eventually, it just took a little bit longer. So this particular trade, when I get into the later lessons of exactly how we manage each and every position, we already know that the worst case scenario, we would have had a break even and we wouldn't have lost any money. So the most important thing is understanding how you can really build on that. And even on just a short-term little move, the fact that we would have banked 7.6% and maybe a little bit of profit here, or worst case scenario, break even, shows you the power of the strategy, because we're just trading within the corrective phase. We haven't even got started yet, let alone when we catch the impulses. So if you think about, if you're able to capitalize within these sections and we haven't even got started with the bigger moves, it shows you how much potential that we have. But now let's take a look at another risk entry within the section and a couple of more reduced risks so you can really see them. A great thing and a great exercise to do here, guys and girls, is now that you're understanding how simple these patterns are, is go on any currency pair like on the other exercises that you've done, and then focus and see these ascending channels, descending channels, bear flags, bull flags, and then see how they react, and draw your risk to reward tool and see what potential they have, and look at those target areas. So as you can see here, this is more of a rising wedge formation, and what we'll be looking at is a risk entry. So notice how I said sometimes you're going to be able to get in a bit tighter. In this type of situation, 25 pip stop, again dark targeting the double bottom area, we've got 10%, actually a little bit more, nearly 11% to double bottom. And by doing that, we will first always see how does it react to the beginning of the correction first. So at least that way we can know that what is our worst case scenario. So for a target, we know there's about just under 6%. So that's good enough. We've got a 6 to 1. We're risking 1% to bank 6% just within this move. And we know that there's a 90% probability that if we break here, we're going to get here. That is a game changer, knowing that it's a minimum of 6%. What happens within the market is that people have these imaginary support lines and resistance lines that, you know, it touched a resistant line one or twice in the past, when in reality that means nothing. It's not proven to do that. it has no reliability that if there was a resistance line here, for example, see how we rejected off that resistance, that if it ever came to this resistance that is going to reject again. What is actually happening is that sometimes within those areas that it's rejecting off what people would think is a resistance, it's actually a pattern or a structure. And that's why you'll see something where it bounced off of a resistance 3 times and then it broke through. And on that time that it broke through, you was looking to sell it and then you lost money and thought, do you know what, that's a trade that just didn't work out. When in reality, that's not the case. I can almost guarantee I could go through each and every one of those trades and see there was a pattern there that would give us the edge to understand when to stay out of that position. So just something to think about, especially if you've learned from things like support and resistance in the past. It really is not going to serve you longer term, and that's proven. So looking at this and going back to the entry types, we have our risk entry here, and then we have 2 opportunities to get involved in the market. But I'm only going to highlight one here. And the reason as to why it's not realistic that you're going to get every single move. You're going to get a lot of them, but not every single move. So as you can see, we do get, if I move this out of the way, we get another entry here. And of course, targeting double bottom area. And we have about 6.3% potential. We nearly get there. We get a lot of percentage anyway. And we have that correction. Let's say you didn't happen to get that correction because maybe you was asleep for whatever reason. You have another opportunity. And what you're going to find with them, Falcon, is that there is no way that you can ever have an excuse that I couldn't be by the charts or I couldn't be by the screen. Because where we forecast and we plan in advance so much, we are so detailed and we understand what's happening within the market. The majority of the time, these trades take 6 to 8 hours, 10 hours, sometimes 14 hours to be ready. So it's very likely within a 6 to 8 hour or 14-hour period that you're able to check the charts or see that. And where you've planned in advance, you set your entry orders and it does it automatically for you. So very, very easy. So as you can see, risk entry, first scale in, second scale in. If you didn't get into this position at all, this would be your first entry and then that would be your scale in. Or if you didn't get into the risk entry and you didn't get into this position and you took this, this would just be your first position without a scale in. You're not always going to get the scale ins, but you can see how we always have a multiple amount of opportunities to get involved in the market. And we're taking it on the break of the flag and having our stop just above the structure of the flag. So very, very simple. That's how simple we really keep it, guys and girls. So that is setting our entry orders, our entry types. So the main ones are risk entry and reduce risk. We're setting our entries 4 to 6 pips below the structure. To summarize, a lot of our risk entries are going to come at the top of structures or at the bottom of structures. And when we're taking our reduced risk or risk entry, it really does come down to your personality, which you're going to learn over a period of time, what's more comfortable for you and what suits you. Some people are not comfortable trading within the pattern. Some people prefer to trade within the pattern, or some people prefer to wait for these flags and then they take them. It's entirely up to you, and you don't need to put any pressure on yourself at this stage. At this stage, you just want to learn it as much as possible. So do the exercise, go through all the currency pairs, and make sure you see as many and mark on all of these patterns, and you're going to learn a lot. And it's the best exercise that you can do right now with what you've just learned. Also to note, take a look and utilize your ray lines for targets and understand that that is how simple we keep it. And we're always looking to take a message from the market by seeing if it creates any different type of patterns for us to get out. Say, for example, you're selling this and it moves all the way down and then it creates a descending reversal. Then you know that it's likely that you want to look to take profit because it's creating a reversal channel to the upside. So literally keeping it as simple as that. It really isn't complicated and it needs to be as simple as possible. And that's what's unique within Falcon. So there you have it, guys and girls. These are the entry types and scaling in. You've seen the power. The amount of opportunity we can take in the market is absolutely insane. So work hard within this episode. Make sure that you really hone in the strategy as much as possible, because once you get it and you understand all the rest of the components and you stick to the low risk 1% model, you're going to find that not only do you get involved in a position, you build on it, you scale into it. And then when you match that with compound interest, wow, the percentages are enormous. So keep going with it, and I look forward to seeing you in the next part of the section. So now you have an understanding about patterns. Let's take that one step further. I want to give you guys and girls an insight into what we focus on our weekly webinars every single week with the community. We're always looking at pattern identification, but it's not always about what the pattern is and how it's looking. It's also about how does it behave specifically to the currency pair. Certain currencies, they behave in a certain way, and some currencies, they repeat particular patterns over and over again. What that does, that gives us that next level of behavior to understand what it potentially can do next. So I'm going to take you to a clip now to last night's webinar with the community where we discuss some specific pattern behavior on the euro over the Australian dollar. So let's take a look at that now.
But let's break this down, because this is pure behavior. And I love this because when I saw this pattern as I was doing my analysis, it reminded me of how far that you can really take your mind on a subconscious level to really get to that next stage, which is why I focus on these things, so you guys and girls can build that practical skill. It's just like training a muscle. It gets better over time as you consistently do it, but make sure that you're working it the right way to get optimal progression. And that's how we do that through forecasting. So if we go to the daily chart, we can see that overall structure. We know that this structure is unsustainable to move up in this direction without having a deeper pullback to the downside, or a deeper correction, or a deeper impulse. So by knowing that, we're looking for the impulsive break for the 90% probability rule to come into play. So let's take a look at that now. It's very, very close. And this is why this kind of trade gets exciting to me, because of that. You could say on the weekly, it's not an impulsive break through that much, but it's essentially it's breaking impulsively. And if you look at the last two previous times, big rejection, spiking rejection, and now we've got that impulse. Is this going to give us the momentum to give us this? So that's exactly what we need to understand. The only possibility I see happening is either getting a sideways deeper continuation, in which it would just take a little bit longer to play out, which will just mean that we require a bit of patience, for example, or this impulses to the upside gives us a continuation and some short-term buy setups, and then it comes down for the bigger sell. But at this stage, judging on the momentum, I think this move to the upside is becoming less and less likely. So let's look at the lower time frames and make sure that you understand the behavior here. So on the daily chart, you can see that we are getting a lovely amount of momentum to the downside, but it's just starting to slow down here. When we go to the 4 hour, I can see why that some of you are looking at it for a long. I get it, right? Let me just remove the trend line out of the way, so then we can just dig into the pattern. I can see why you're looking at it, because you're looking at it as one big descending channel. And you're seeing this as a potential to trickle its way down, create a descending formation, and take a risk entry in here. I can see why you're looking at that to take that long. But one thing that really struck to me was something on the 1 hour, so you can see exactly what I'm looking at, which is the behavior of how certain patterns behave and how this is behaving right now. So for those of you that are new to patterns, we focus on them heavily because they give us the truest form of the overall direction. So let's take a look at it on the 1 hour. If we look at the current pattern here, what does this look like this forming to you? And the question that you should be asking yourself is, can you see this pattern or something similar to this pattern forming within the current price, either over here, or more so the more recent current price action? So as we see that structure, this one particularly that I looked at, so when I zoom in, I can see this. I'm looking at this typical pattern that this is what the market does. It gives us an impulse down and it gives us a flag. So if we just remove this is going to give you so much clarity. If we remove this, what does that look like? That looks like a continuation to head lower, doesn't it? Right? And as you can see, when the market plays out, it does exactly what we expect. As it plays out, what does it do? It completely retraces. And when it gives us that kind of move, it's starting to create a different type of correction that I think is very likely. So yes, that short-term buy, if it correctively went lower, is possible, but we've had a solid rejection off of here. So we can identify this as the bottom of the flag, like this. And then what we want to look at is this. If we look at this here, and move off of the ascending channel, so we get the impulse, get this correction here, we get an impulse. Look at this section here. What does that look like to you guys? See that? Flag. Got the sell there. Goes back up, so that's a break-even trade. Creates a deeper correction, and then drops. It actually gives us a similar, this isn't as similar, but we just get a correction here, which is typical, but we get another one here. As you can see, it moves down, tiny little flag type formation, an impulse down, takes you back out for break even, and then it gives us another opportunity for the bigger sell. So what is this in here? Can we identify anything here? So you can see how that we're looking at the current behavior. This is what gives us an edge. So this is where I was looking for the potential that it could give us a long and it could go back to the upside and give us a descending structure and move back up. There was a possibility, and it still is. But the more and more we look at it, you can't deny when you see these patterns playing out and the structure that they have, the only thing that this has more in favor than this one is slightly more flat. This is slightly more bottomed out to potentially move back like this, where in fact these ones and these ones here have a far more ascending type nature to it. As you can see, this has got more of a continuation ascending nature, but it is slightly more neutral, it's slightly more flat. So that's the only side of it that, let's say, I would prefer these over these. But you can see from a pattern perspective, that is as clear as day. And then what we can look at for it is this. We can take a lovely risk entry at the top of that structure. So let's take a look. We'll look at it here. I'll be looking at this. I know exactly what you guys and girls are talking about, but the main thing that I'm focusing on is the actual pattern, because I had exactly the same thing in, and I think what's going to be more reliable for us for the week ahead is this, because we've literally just seen the replica of this playing out 2 or 3 times. It's exactly the same, and it's not even just that we're looking at a correction. We're looking at how the correction behaves. It's like this happens a lot, not just on Euro. This is quite specific to Euro Aussie, but it does happen a lot. We get an impulse down, we get a flag. So you take that trade, we'll come back out, take you for a break even, create a deeper correction. We'll slightly do it here, but then done it again here, and now it's doing it again here. The only other side is just this is more flat and that's more ascending, which this gives us a higher probability than this one, but it's still there for us. So by knowing that, that is exactly why I'm only looking for the sell at this stage, because of that. A nice corrective nature at the top, 20 to 30 pip stop, risk entry. Target is 2% to here, but I'm not actually targeting that. I'm targeting this. I'm anticipating this could be the break. So if this is the break here, like this, take a look at that in a bit more detail. So if this is actually the break, I'll do this here. You can see that we've slightly broken the trend line, but remember, the trend line is there just as a guide. It really is the pattern of how it breaks is going to give us the edge within the market. But if we get that, and then it's, let's say, it happens to line up at the back end of the trend line, if you wanted to use that as, let's say, an extra layer, take the trade, that's fine too. But overall, this is exactly how we can forecast that, understand the true behavior. This is what you call taking a message from the market, not just an impulse or a correction. You're looking back and you're seeing, not only do we have a correction, you can see exactly how it plays out. So when I see a structure like this, I saw it and I thought, oh, this is familiar. And it sparked off something in my head. This is quite specific to Euro Aussie, through back testing and having that behavioral standpoint. And then I look back in the previous price and, coincidence, you can see it 2 or 3 times. And what you're going to find with patterns is you see how they behave. And then all we have to factor in here, guys, is that if this did break to the upside, that's fine. 1 in 10 chance that'll happen based on this structure. If it does that, then I'm not in the trade anyway. So you don't lose any money. What we're focusing on here is the impulse on the way down. So by doing that, it gives us a nice standpoint. I know this has the element of, a double bottom here to then move to the upside, the same way that we had that here as the double bottom element, same way that we would have it. So that's the only, let's say, negative, that this is more like neutral, but it still has potential. So looking forward to see this part, really, really looking forward to seeing if this one plays out.
So as you can see from the clip, that we was looking at that particular specific price behavior, and it's understanding those intricate little details that really gives you a true edge within the market. There's one thing understanding that there's a continuation, and there's another next level thing understanding how it may behave specific to its behavior, and looking left within the structure, How did that particularly behave? Can it repeat itself, and can I capitalize on it? So let's take a look at that. So as you can see with the price structure here, with the euro over the Australian dollar, we know that from understanding pattern identification that we have this bigger structure here. We have the bigger ascending channel. We know a big ascending channel, this is a reversal type structure. So we're looking for this to come to the bottom of the correction. And as you can see, we've broken impulsively out of that structure. But let's actually look at the little details that we discussed in the webinar of how we can use that as an edge and how that can help us. So if we go down now to the 1 hour chart, let's take a look at that. So as previously discussed, you can see that this particular structure has similar price patterns. Now from the webinar, we was looking at this particular price structure. So as you can see exactly how that played out. What I'm going to do now is just remove the trend line so you can just focus on the pattern itself. Now as we look at the pattern, you can see if we look left, how did that previously behave? So what we was focusing on is the fact that this particular structure here, does it have any similarities to previous price? Well, let's start from the top. As you can see this structure here, where do we come from? So we have the overall ascending channel, which we know is a reversal. We have our impulse down, and this is a continuation. So we know this is a bigger bear flag continuation to head lower. But it's one thing understanding that and then understanding how it behaves. So by looking at what this structure looks like and how it can behave, what is interesting about it? Well, we impulse down, we have a little correction, we impulse down, we move back up, this is where you would likely take a sell setup and then take a break even, and it just develops into something further where you can take another entry at the double top. And as you can see, it breaks back down and then breaks out. Now, the reason why we was expecting that within the webinar is such a high probability to break to the downside was purely because, well, look at this structure. A carbon copy there. As you can see, we have an impulse, we have a correction, we impulse down, we trickle back up for a double top area, and then we trickle our way down, and essentially we move down for an impulse. And we actually do a similar same thing here. Not as much, but you can see we have a correction, we impulse down, we correct up, and then we drop again for the impulse. So we know the whole way down, this is just impulse, correction, impulse, correction, impulse, correction, impulse, correction. So what are we going to expect? Impulse. So that is the basic level part of the continuation. We're expecting an impulse out of this structure. But what took it one step further of understanding its behavior was this intricate little detail here, that we get a correction, it impulses down, creates a double top type formation, and then breaks further. That is what is really getting that next edge within the market, the next level. It's taking your analysis to the next level. And as you can see, even with this structure here, it's exactly the same thing. We get an impulse down, we get a tiny bear flag continuation to take it to the downside. So this is where you would sell, and then it moves back up, takes you out for break even. So you don't win or you don't lose, but then you understand that this flag, this tiny flag, is just creating a deeper version of itself to still head that way. As you can see, we just form a correction at the trend line, and then we notice a continuation to impulse down. The 90% probability comes in play again, as we know that. As you can see from what you've learned the whole time, breaking here, 90% raw, we're just linking everything together. So you're going to start to understand how powerful these structures are. So by understanding how a continuation works, and then by understanding the 90% probability rule, understanding the nature and our specific entry types, and then taking that one step further and understanding this little detail here, you see how powerful it really is. And when you're scaling up your account, you're going to need and want confidence within the market that you know something a bit extra. What really gets you those extraordinary results, it's not by understanding basic level of trading, it's understanding that true behavior of the pair. So what all we've done is we've looked left and looked within the section and had that thought process. Is there anything else that I can learn from? Is there any specific behavior that I can focus on? Yes, we can. And then we can look for those entries, and we have two styles of entries, one at the top, one at the top here. As you can see, we have our risk entry at the top, which would be running around 7%. And then we have our other entry on the break, which will be running around 3% from last night, so within 24 hours. And there's, as you get more skilled and you understand price behavior, there's a potential for another trade within this correction. But you want to make sure that your skill level is there first. So multiple opportunities, but what really paved the way is by understanding what the bigger structure is. And as you can see by understanding the multi-time frame analysis, that all of this price to make this happen, this all started with the fact that we understood that structures are always structures within structures. So the same way we're looking at the 90% probability rule on the 1 hour chart, on the 60-minute chart we was looking at that impulse and the correction, and then looking at how the 90% probability rule was going to play out. And then we're looking at this as a bigger structure, and the same thing, we've impulsed out, and now we're looking at the 90% probability rule to come to the downside. So as you can see, it's just a play with structures within structures, and you can see how powerful it really is. But it all starts with that multi-time frame analysis from the higher time frame, linking its way down, and then getting into those extra little bit of details. So I hope you've learned something from this, and you're going to see that specific pattern. It is a continuation pattern, but it just has a slight few variables within it in terms of how it actually behaves. This is a pattern that we've discovered within Falcon that we realize happens over and over again. It's not just a standard bear flag or bull flag. It has that little intricate detail. And what works really well is our management style helps with that, because when you're taking those type of trades, it is unacceptable to take a loss, because if you manage it correctly using the formula, you will always take a break even, and then it will form its deeper structure, and then you'll take the trade again. Really that simple. So just something I want to add in for you guys and girls, and you can see the power of understanding how we forecast these trades ahead of time collectively as a community, how powerful it really is. Now let's take a look at watch lists. So this is something that we utilize in Falcon a lot. We make sure that we have our targeted, specific, tailored watch list that has been filtered out with our best positions for the week ahead. Within Falcon, what we do a lot within the community is we have a top 6. This is our targeted pairs. What you'll find with most strategies, they just look at all the pairs throughout the week, and what that does is it doesn't account for the amount of noise that is in the market, and sometimes there's too much going on. What you'll find is that you're coasting through the particular days and weeks, and you've got all of these currency pairs, and you're just flicking through, and then you're missing moves because you're focusing on too much and you're trying to catch every single position. What is better is finding our top 6 that is targeted and filtered, that meets the criteria. So when it meets the criteria for our particular positions, what we also add in as an extra edge is our reliable pairs. So there's certain pairs within the market that you're going to find that are quite tricky, that are not as reliable in any kind of strategy. And what we've figured out is to stay away from those pairs and focus on what's more reliable. And these are some of them. So the euro over the US dollar, pound over the US dollar, the euro over the Japanese yen, the dollar over the Japanese yen, the US dollar over the Canadian dollar, and the Great British pound over the Japanese yen. So very reliable currency pairs. What you're going to find is throughout the week that 95% of the time that my positions and a lot of people within the community will be from our top 6 within our watch list, because we've forecasted ahead of time, we've forecasted the possible scenarios, we understand what kind of scenarios that we're looking for with the setups, and to top that off, we know that the current behavior of these pairs are very reliable. So when we see the setups on the entry types that we've covered and the overall structures that we're looking at and the patterns, we know if we take those setups on these trades, they're going to be far more reliable than others. So that is what really gives you confidence for the week ahead, that not only are you looking at these particular setups that you know are reliable, you actually have pairs that are tailored to being very reliable as well. So it gives you that extra edge within the market and make sure that it's as targeted as possible. So there we have it with our watch list, guys and girls, and keeping it as simple as possible. Now, some of you, it's important to note that you may have a couple of more. So you might have your top 6 and then you have a couple of wild cards. All that means is, let's say, for example, that you've looked at a lot of pairs, because we normally have a lot of opportunity in the market and it's so easy to get overwhelmed. So what we do is we have our top 6, but you might have 2 more that could have made it into the top 6, but you felt that these were filtered out to be better pairs. What you do in this type of situation is this. Let's say, for example, within the week that you forecasted that there may be a couple of trades on pound yen, all of these pairs, but then on pound yen, USD CAD, and let's say euro yen, what you forecasted hadn't materialized, or it was taking a little bit longer. We might have a structure that needs more time to develop and more time to form. In that type of situation, what I would do is I would then go to, let's say, a couple of wildcard trades that I'm looking at. I might have a few others. So I may have, for example, pound Aussie. So then what I'll do is I'll add that to the list. And then I might have another particular currency pair. Let's say we have the euro over the pound, and then I'll add that in as well. And then that way, if something doesn't materialize on pound yen, on dollar CAD, or euro yen, I may have a particular setup on pound yen, pound Aussie, or euro pound. But 95% of the time, I will take the trades within the top six, month after month, year after year, because it's been targeted and it's specific for a reason. We've done that analysis, and we do that weekly together as a community to make sure that we have our top six ready for the week so we can capitalize. And in the middle of the week, what I normally do is I do a midweek market review every single Wednesday. And then by doing that, we recap of what's happened, what trades have been on the cards, have we managed anything, or is there anything extra to look at that hasn't materialized? So in the middle of the week, it's normally where I would then keep a lookout for trades in my wild card. If on, let's say, Monday, Tuesday, and the majority of Wednesday, the trades that I were looking at, some of the pairs, let's say euro yen, for example, it hasn't developed where I want it to be. What I'll then do is I'll go into my wildcard section, which will just be within the other currency pairs, and I might have, let's say, a couple others like pound yen, pound Aussie, and euro pound, and then I'll just pick from one of those that is the cleanest form that's giving us the reliable pattern. And then if I have that, then I'll take that as well. But like I said, 95% of the time, you're going to take the ones with